All right, folks, we're going to give it a minute till we start. Okay, well, I want to thank everyone for attending this year's summit. I'm obviously Ian Castle, and alongside me today as co-host is Mike Schellinger, and also Michael Liu might be popping in to help out over the next couple of days. It's hard to believe, but this is our seventh summit. I think this is the third in a row that is virtual. And I know some people would have enjoyed having this physically this year, but we make these decisions usually December of last year. So December of last year, we're going through the Omicron variant. And especially because our event's rather international, when it was physical, we had about half the attendees coming from overseas. So we just thought it was better to have another virtual event. And I think it's kind of a blessing in disguise because we are such a global community and we're getting more global, as time goes on. And this year, we have attendees tuning in from 26 different countries. We have companies that are going to be presenting from 7 different countries, which is pretty cool to see. This year's event's a little bit different than other events that we've had, mainly on day one. Normally I would try to find the best 3 or 4 or 5 speakers I could find to come in and educate us during the morning session. And then I'd be followed with some of our best members pitching their favorite stocks in the afternoon. And I thought, maybe we mix it up a little bit. And I was talking to Mike about it. And I kind of like the format of this year's event on day one. We really tried to find the best 15 to 20, actually this year it's 19, best microcap stock pickers we could find. And you really have them come in and not only give us their best pick, but also educate us on their strategy, their process, and what makes them unique. And so I'm really excited about day one today and some of the ideas we'll be hearing, but also how these investors think about their strategy and process. Tomorrow, we'll have 12 microcap presentations. I really think you're going to enjoy this small but eclectic lineup of companies. I mean, we have 10 million market cap companies. We have 300 million market cap companies. We have companies that are, like I said before, presenting from Canada, Australia, the UK, Sweden, Finland. It's pretty wild, even though we only have a dozen companies. It's a very diverse set of companies. We have dog food companies, software companies, diagnostic companies, and even companies building airlines. So, you might not want to invest in every single one of these companies tomorrow, but I guarantee that you're going to find each one of these presentations entertaining at the very least. So, what I thought I would do is just get right into it today. Again, we have 19 investors that are going to be telling us about their strategy, their process, and their best idea. We're going to be taking Q&A if there's time. Each one of these investors has 20 minutes. And whatever time is left, we'll take Q&A from you, the audience. And just as a reminder to ask your questions, you click the Q&A button at the bottom of your Zoom screen, and then just type your questions in there, and then we'll be taking them if we have time. Just a quick formality, quick disclaimer. The purpose of this presentation these presentations today is for informational and educational purposes only, and should not be construed as a recommendation to purchase or to buy or sell any security. Microcap Club is not a registered investment advisor. Microcap Club, its partners, members, subscribers, affiliates may or may not hold positions in one or more of these securities mentioned and may trade in these securities at any time. Do your own diligence. Don't buy any of these. Talk to an advisor if you want to. So with that formality out of the way, I have a good friend of mine, Neil Cataldi of Blueprint Capital Management, that has agreed to bat leadoff. And so Neil, take it from here.
Thanks, Ian. Let me share the screen first. So I've been a part of Microcap Club community for almost 10 years now. And before I really get into it, I just want to say I can't say enough about the platform. It's allowed me the opportunity to collaborate, meet other like-minded investors, and really just learn a lot from smart people like those presenting after me today. As an investor, learning is everything, and this platform plus its people are a special group. I think that's why we're all here. I've been asked to talk a bit today about the strategy I manage, what makes me unique, and to share a company that's representative of my investment discipline and philosophy. Real quick before I begin, got my own disclaimer. Short, the information contained in this presentation is for informational purposes only. My presentation has all been prepared on the basis of publicly available information, and this should not be considered investment advice. With that said, the question about what makes me unique, especially in a group such as this, is honestly the most challenging to me. I have an incredible amount of respect for those in my network who I collaborate with daily. I think we're all here speaking today because we have a similar passion about the microcap space. We roll up our sleeves, we do deep dives on research, and we're probably all a little bit relentless with our desire to find the next company we really like. Where I think each of us differs is in the experiences we've had prior to managing our strategies. So I'm going to spend a little bit of time on that today. I'll share a few quick stories about past experiences working in the world of investments and the lessons I learned as an investor early on that I believe have shaped who I am today. That being said, to start, I've been an investor for 25 years. I started college in 1997 and was fortunate enough to receive a full academic scholarship, which afforded me with some money to get involved in the stock market. The timing was great. I was shooting fish in a barrel at the beginning of the tech boom during that period, and I didn't know anything, but I grew a portfolio 400% in 3 years. And during my senior year, I lost mostly all of it when the market collapsed. The dollar amounts are irrelevant, but it was significant money and more than I'd ever been so close to at that time in my life. The loss left a mark, but ultimately was the first brick, if you will, in the foundation that would become how I invest. When I graduated college, the education I received during that period felt much more impactful through the experience I had making and losing a lot of money than in the actual classroom. I stepped into the real world ambitious and motivated to learn more, so I could never lose like that again. And importantly, I think having a sensitivity to loss early on in my career allowed me to understand risk in a personal, real way that I still carry with me every day 25 years later. We won't win all of the time, but playing for a decent batting average means we need to always evaluate risk reward scenarios. And this is a discipline that I walked away with and hope to always be refining. Post-college, my first job was trading options on the Philadelphia Stock Exchange. I worked initially for a small mom and pop type firm. We learned with pencils and paper. It was a lost art even at that time. A division of Goldman Sachs bought the company about a year after I started, which shifted the focus of risk management from individual traders to the group as a whole. And this was a different mentality, but the experience taught me about trading. And importantly, it was the first time I realized how valuable small pieces of information could be. We're taught that markets are efficient, but at this time in my life, I noticed they might not always be. A few years later, I moved off the trading floor with Susquehanna International Group as a derivative strategist. It was here my skills were refined more around digging for information not understood or priced into the market. My job was to help traders identify order flow and or opportunity in the options market the market was missing. And over that 5-year period, I watched again how little pieces of information could be taken advantage of in the market for significant gains. And this is where my microcap strategy was ultimately born. I had always been intrigued by smaller companies, and I had success investing in them on my own. I used that experience to launch Blueprint. The philosophy is simple, with a basic tenet to find and exploit information inefficiencies. The view is that most investors are underexposed to microcaps, and institutions that have been in the space are leaving faster than new ones are deciding this is where they want their focus to be. A sound research process married with direct access to management is the idea, with a goal to find 10 to 15 best ideas and put them in a portfolio. I have a long-term time horizon, but also have the flexibility to take advantage of tactical shorter-term opportunities. I'm sector agnostic, but lean heavy on technology. And really, I just turn over a lot of rocks. I talk to a lot of management teams, and I have a deep network I lean on for idea flow and collaborative research. When I'm looking for companies, I seek excellent operators who have their own skin in the game, businesses built to scale with at least early signs of business model validation. And importantly, I'm trying to find information that is of value that the market's not appreciating as it should. I know it's a generic statement and you're probably thinking, what does he even find? It's not always the same. Maybe it's a new contract win the company hasn't announced, but is publicly available elsewhere. Maybe it's information that can be found through independent sources who work with the company, such as like a reseller partnership. Or maybe it's a business model characteristic that puts the company in an advantageous position, but is mostly being ignored. Remember, a lot of people that do this research for large cap companies aren't doing it in microcaps. So that's what makes us all in this group unique in a way. I spend a lot of time in this facet of the process researching and seeking new inputs that can help increase or decrease my confidence in the progression of company and ultimately my investment, maybe making over time. The market in this subset we're focused on doesn't always appreciate things when it should, and as a result, sometimes overreacts. I'd like to think I've been trained to identify those moments, which I can use to my benefit. And I don't know how unique this all makes me because we're all really good at hunting the next opportunity. I know my background and some of what I've just shared briefly allows me to research companies well, process information, and determine how to use that information to increase the probability my investments will be successful. So let's now pivot to a company that I think reflects quite a bit of what I look for in an investment, but also an overlooked facet of the business that is as it's appreciated greater, should lead to favorable results for the company. I'm not opposed to being early or playing contrarian. In this case, the theme is a bit contrarian as well. The company is called Fathom Holdings, and the ticker is FTHM. Fathom was founded in 2009, but only IPO'd on the NASDAQ a little over 2 years ago. The company sold 3.5 million shares at $10. The stock ran to 54 in early 2021 and is now down 90% to it's actually $6 a share now, given what happened in the last 2 days. The current market cap is also 105 million now. They're debt-free and they have nearly 20 million in cash on their balance sheet. With market conditions challenging, I'm spending more time searching for companies right now that I think the market's overlooking or has thrown away. And given the movement in Fathom over the past 6 to 12 months, I think they may be one of them as the investor sentiment is so negative. So let's dive in a bit. First, I spoke about strong operators with skin in the game. Josh Harley is the CEO and founder. He and his family own over 40% of the company. Founder-led companies are of particular interest to me when I'm searching for new ideas. I think obviously management's number one, as we all know. And in this case, they've executed quite well on their plan during their 2 years as a public company, despite the share performance. In terms of Fathom business, Fathom is a fast-growing residential real estate brokerage platform with a differentiated commission model compared to every other real estate brokerage that is publicly traded. I think the company has already likely arrived at where the real estate industry is going to move towards. They operate in 38 states today, and its value proposition is very clear to agents, supported by their consistent 50% agent growth, as well as half the industry's normal attrition rate. As the slide shows, Fathom grew revenue in 2021 by 87%. And so far this year, revenue's grown 81% in the first quarter and 52% in the second quarter. They've guided 2022 revenue to 425 million. This is a high growth story that should remain one and already has notable scale. The key differentiator and direction the industry is going to move towards is their flat fee model to the agents who only pay $500 per real estate transaction. Most other brokerages charge agents as much as 30% of an agent's commission. And this difference is quite material, especially for the higher producing agents who close a lot more transactions. The takeaway, and the reason Fathom is growing so fast is simple. The platform technology is good and the agents keep much more of their commission dollars, so more and more agents are moving to the platform. I want to talk about a few aspects of their business in more detail. The first is this commission structure, and I have a few slides that will help visualize the industry today. So Stevens initiated on the company a few months back and put together this comparison of the brokerage models. I think this is important. There are really 5 buckets. On the left, you've got the classic commission split with the brokerage. And this is what people most commonly think of in the real estate industry. It's also the largest piece. Names like Keller Williams, Century 21, et cetera. This bucket is what Fathom is looking to disrupt the most. The second category, classic commission split with equity comp. EXP has been a huge name in real estate over the past few years. Their model is to come up with a split, such as the first bucket, but also add equity issuance on top based off of production targets. In the middle, you've got a hybrid model, such as Remax, that has lower splits, but other fees going to the agent. And then on the far right, you've got companies like Redfin that exist who just pay like a set salary with bonuses. None of the major brokerages are doing flat fee, 100% commission-based model today for their agents. And of the ones that are doing this in the fourth category where Fathom is by far growing the fastest by every metric. So let's look at some quick math on how significant the difference is for a typical agent working with the classic commission model. Fathom agents pay a $600 annual fee on their first sale, plus they pay $500 on each sale 1 through 12. That's it. And after 12 sales, they only pay $99. So as the slide shows, on a $350,000 house, a Fathom agent will pay $500 and they'll make $10,000 in commission. On the right-hand side with the traditional brokerage, their split is more like 3,000 plus to the broker and a little over 7,000 to them. So this is the key math and the differentiator that I'd ask you to remember as you continue listening about the company. It's really the reason why people are switching and should continue to switch at a faster rate. Let's talk about agent growth, which is the most important metric within their business to me. As of June 30th, agents had grown to nearly 10,000, and management believes they can continue to grow at a 50% rate in the years to come. This metric and dynamic around agent growth is where I believe the market is not appreciating the opportunity Fathom is going to quickly take advantage of. During the first part of my presentation today, I spoke about identifying opportunities in the market that are at times underappreciated. This aspect of Fathom is where I believe my appreciation for what may be coming is different than that of the market. And it's when this happens within a strong fundamental story that I get excited about the long-term prospects of an investment. The success of Fathom, in my opinion, is not a function of transactions right now. Rather, it is most tied to their ability to add agents over the next few years. In a strong housing market like that which we've experienced, agents are too busy closing transactions to think about switching. The real estate market in the past 2 years post-pandemic was operating at an unprecedented level. However, now that things are slowing and in some cases, screeching to a halt, the time's never been better for change. So take the slide before I ask you to remember with the commission dollars, and imagine you're a real estate agent. Your number one expense is the commission you split back to your brokerage firm. As the frequency of your transactions decline, which is happening for all of them right now, how do you make up the difference in income? Now think back to the hypothetical and multiply that difference that we showed on a $350,000 house, which was almost $3,000 to the agent. You multiply that by 10 or even 50,000 or 10 or 15 homes per year, and you can easily see how an agent can make up a big difference in that income. This pay gap holds up across all types of producers as well. Generally speaking, the average producer at a traditional broker could see a 25% drop in transactions, but still make more money at Fathom. And I think this is why people will continue to switch when the market is challenging. It's a compelling proposition at the right time and explains why Fathom is taking market share, and also why they may exit this part of the cycle far stronger than they were before. One more point on that, there's early data supporting the notion as well. Organic agent growth picked up in the past quarter, despite a seasonally difficult period for recruiting. The second and third quarters are typically the worst for recruiting because they're the busiest from a seasonal perspective for people to move. And this is also important. July was their second best month for recruiting ever, according to the CFO. This data point, in contrast to the industry slowdown, I think is an early sign their ability to scale the platform may accelerate significantly in the coming quarters. Quick slide on agent acquisition costs, because this is pretty relevant too. They're under $1,000 an agent. So the payback for Fathom is less than one transaction when they acquire new agents. They're delivering a 21 times lifetime value to customer acquisition cost, which I think really de-risks the growth profile significantly as they allocate capital to scaling the business. And this metric speaks pretty loud to me that it's a powerful platform as the numbers continue to grow. And then the third interesting piece of their business that may not also be appreciated today pertains to their ancillary services. In the 2 years since they launched on the NASDAQ, Fathom has bolstered their service offering to not only include the standard brokerage transaction, but now they also attach lead gen, title, insurance, and mortgage. The operations of these businesses were acquired and only in recent quarters have begun to contribute. This slide shows a hypothetical revenue per business line example of what they can make on a transaction. While the profit margins initially are quite low on the base real estate transaction, which is what they've been primarily thus far, the additional services have much greater profitability, which is going to give the company significant leverage as it scales transactions with higher attach rates. Management has begun to provide more evidence this is working. They are already seeing 4 to 5% attach rates in areas where mortgage and title have been launched. And like most businesses, the investments they're making into this growth opportunity are really the primary reason why they're not profitable today. So I have limited time, and there's a lot to this story. I'll just add a couple more quick thoughts before I wrap it up. The core real estate business reported 13,000 transactions during the second quarter and has already scaled to break even. I think that's pretty important. Management has provided framework for long-term guidance. They can generate 40 million in EBITDA at 100,000 transactions annually. This assumes a 10% attach rate on the ancillary services we spoke about. And as I just said, they reported over 13,000 transactions in the last quarter. If they keep growing agents 50% a year, they're really not far from approaching 100,000 transactions in the next few years. And the market cap's only 105 million today. Separately, and lastly, the company's repurchased 686,000 shares during 2022 at an average price of $8.75. It's 30% higher than the current price. And their CFO purchased 30,000 shares in the open market during June at prices around $10. They're pretty confident this valuation is cheap, and I like names where management is taking action like they are in this manner. So yeah, with all that said, I'll hand the floor back to Ian, who I wish to thank again for the opportunity today. And I'll just conclude with this. I'm always happy to chat with other investors. If you found this helpful and/or would like to discuss anything further, please don't hesitate to reach out. My email is neil@blueprintcm.com. Thanks.
Thanks, Neil.
Yeah.
Yeah, we're bumping up against the 20-minute mark for Neil, so we're not gonna be able to take any questions. But we want to thank Neil for running through the pitch on Fathom. And our next presenter is Tom Bachrach. And just once again, you know, if we do have time for questions, you put those questions in the Q&A button at the bottom of your screen, your Zoom screen. And if we have enough time, we'll get to a couple questions where we can. So Tom, the floor is yours.
All right, so Ian's probably panicking because he knows how much I like to talk and he's trying to keep us on schedule. So, but don't worry, Ian, I'm going to get us back on schedule here. So here, let me share my screen first. This is the most dangerous part if you know how good I am at Zoom. All right. All right. So everyone can hear me and you can see the screen.
Looks good.
All
I can
right.
hear you.
All right. All right. So anyway, first of all, good morning. Tom Bachrach, PFH Capital. Just want to reiterate what Neil said about Ian and Mike and everyone else at Microcap Club. They do so much work and we all contribute so little and benefit from everything they do. And you know, very grateful for that and happy to be here. I'm just going to do some really quick background on PFH Capital so we can get on to the idea. So we're a long-only investment partnership. We aim to build an unlevered portfolio of our best, 10 to 20 ideas. 90% of the time, plus we're talking publicly traded equities. We operate with a flexible mindset. We like our deep value, our commodity plays, or things like that. But our ideal long-term holdings usually have, strong insider alignment, solid financial health, the potential to reinvest earnings at a high growth, earnings and growth at a high rate of return. And of course, we want to pay as little as possible, well below our measurement of intrinsic value if possible. Now, it turns out, of course, it's hard to find high quality businesses selling for well below intrinsic value. They are rare. So where possible, we just try to hunt where there's less competition. Obviously, I'm speaking at a microcap summit, so Nano, Microcaps, two illiquid for large fund peers. They are obviously a major place we hunt. We also like to hunt kind of off the beaten path. We have global custody in 100 markets. We like to go to markets which are can be inaccessible to small fund peers due to custody challenges, things like that. When we combine the two, it's actually our favorite. For example, we have a couple microcap investments in Egypt, where I used to live. When we can combine both microcaps and off the beaten path markets, we believe we're competing with fewer smart investing peers and perhaps getting a better price. So I just want to jump right in the idea here. So Spirasoft is in Poland. We would argue it would be classified as GARPy, as in growth at a reasonable price. Trades a little over $30,000 USD per day. Has a stable share count. There's an incentive plan that's going to tick the figure up by about 5% by 2026, so call it 1% a year. Market cap's about $74 million USD. I'm converting it there as of this morning. Enterprise value is a little less. They don't have, they essentially have zero debt. They're net cash. It's trading about 16 times my estimated run rate earnings. And in terms of alignment, the insiders, including co-founder, CEO, Konrad Weiska, own a lot of shares. And actually, and they don't pay themselves much at all. Collectively, the market value of their equity exceeded their compensation by over 1,000 times in 2021. I would call that very strong alignment. So, what do? They do outsource software development. You would be familiar with kind of larger peers like, EPAM Systems, Luxoft, Cognizant, Infosys, people like that. Essentially businesses have a certain need. They need to develop, implement a given software solution, and they can hire people like Spirasoft to do so. The game ultimately for Spirasoft is kind of an arbitrage. You retain talented programs, ideally in low-cost jurisdictions. You sell their services to customers, ideally in high-cost jurisdictions. So, the performance to date has really been incredible since they were founded in 2016. You see revenue growth, CAGR 106% per year. They've averaged 96% return on equity. They were tagged Europe's fastest growing tech business by Financial Times in 2021. The interesting thing is they actually still are quite small, which is why I'm presenting them at a microcap summit. Revenues run rates about 50 million. Their market was estimated by their peer EPAM as probably about 150 billion. So they have really a lot of room to grow. Just to talk about a couple of these measures, these numbers are pretty big. I would expect, obviously ROE would come down with growth. It was 54% last quarter, which is still, very high, but, it's not realistic to grow 96% a year forever. The high growth also necessitates kind of working capital reinvestment. So the free cash flow conversion has really been depressed to date. But unlike ROE, we actually should expect that to increase as growth moderates a bit. And there are recent signs it is. Free cash flow conversion was 80% last quarter, for example. I just kind of threw in a quote at the bottom. I think it relates to their success to date. I'll read it. It's, this is from their CEO, Conrad. So he said, we decided, it was in response to a question about innovation. And he said, we decided not to be very innovative. The sad reality is that if you're innovative, then you need to educate the market. And education in the market takes time, and in most cases is a failure. We just decided to do things slightly better than the competition, which we knew very well. And they know them very well because they came from them. You know, I find, you know, when people produce performance and or don't feel the need to attach a save the world story to it, yeah, I find that refreshing today. So, you know, in terms of kind of the keys to success, you know, obviously the first one really comes from just simply basing themselves in Poland. It's, you know, they're really not the first business to generate strong returns on capital from software development in Poland. There are quite a few who've done that. Essentially, you have a lot of, you have a high number of high quality technical universities, which are pushing out a huge labor talent pool in Poland, but cost of living still remains relatively low compared to the US and Western Europe. English proficiency is very high there, which is good for outsourcing. And of course, Poland shares a time zone with much of Europe. They're only about an hour off from the UK. They're the same as, you know, Germany, France. And by the way, I just want to say, actually, I'm looking over my other screen over here. It's not just people are cheaper there. They're actually pretty much about the best coders you'll find in the world. I'm looking at Hacker Rank, you know, which is they rank across a bunch of developer challenges, and they have China #1, Russia 2, and Poland 3 most recently. And I would venture to guess Russia, after some of the exodus we're seeing right now in the programming community, is probably going to slip behind Poland soon enough. I'll add one more thing on Poland. Anecdotally, I can confirm Polish labor productivity is a real thing. Our only analyst at PFH Capital is from Poland. He's based in Poland. I'm going to give a shout out to him. He's Marcin Kramer. He's currently on the call here. Just to give a little example of what you get when you outsource to Poland. I asked him to do a little scuttlebutt on Spirisoft and figured he'd chat to 3 or 4 people. I think the latest figure was 40 last time I checked. So long story short, don't bet against Polish work ethic. Obviously, though, there's more to the business than just basing yourself in Poland. Really, employees are critical. They're extremely customer facing. They're deeply embedded in the customer's operations. You really need to afford them a necessary degree of independence from corporate management. You know, good employees, they attract and retain good customers, and it truly works in the opposite direction as well. Retaining good employees is about having good customers, good projects. Thus, it's really vital to set the right culture to attract those good employees. That's really where you push on the flywheel in this business. You don't do that with cheap gimmicks either. You know, if you listen to an interview with Spirisoft CEO, he basically says the right culture is 1, hyper engineer focused. They basically try to make sure everyone there, including the receptionist, has an IT background or experience in some way. And you have to follow a very decentralized model. Yeah, I included a few quotes on the slide to kind of that effect. The quote on the organizational structure, where he talks about having the engineers on top and him, the CEO, being a support role. Yeah, anyone can say that, but it's backed by deed. He paid himself 60,000 Polish zloty as a base salary. That's about $15,000. So, you know, he's backing that by deed. You know, regarding decentralized structure, I just want to highlight also that the top business unit management, who's functioning pretty independently, they can receive stakes in their subsidiaries, which is seen as non-controlling interest in the financials. And that kind of can, you know, that's used to retain entrepreneurial minded employees who may otherwise go out and form their own business and compete with Spirisoft, and also just to, you know, further increase shareholder alignment. So, you know, you have to you can't just put up some quotes and say, okay, yeah, they have a good culture. You have to try to your best to really, you know, evaluate it. Our best idea of how to do that was just to reach out to a ton of people, talk to a lot of current and former employees, try to gauge employee satisfaction. So Out of the 15 we spoke with, I should say Martine spoke with, my Polish is non-existent. 13 were positive and 2 were negative. The negative ones weren't overly concerning. One related to a lower level manager. The other one related to a guy who's since left the company. We heard nothing but positive comments about CEO Conrad Weiska, the culture he's setting. We think he's gotten it right. And I want to add something else. It's just as a side note, when you're talking to a lot of people, it became really clear during that process that it's hard to get a job at Spirasoft, and also it's also kind of hard to get a raise at Spirasoft, and that's kind of a pleasant surprise to hear in an industry where labor scarcity really could be the major challenge. So good sign they're doing something right. They put out a strategic plan for kind of a 5-year plan, taking them through the end of 2026. It's they're targeting about 25 to 35% annual revenue growth. That's ambitious, but it's not really crazy for a company that's been doing over 100% the last 4 years. I think they did 69% the most recent quarter. And remember, of course, they're $50 million revenue in a $150 billion industry. There's going to be some headwinds on that growth. The one I'd highlight first and foremost is just the macro growth outlook in Europe could not be more terrible. With you got an energy crisis, inflation issues, but there's also tailwinds. Some of their major competitors were in Russia and Belarus, and they're getting squeezed out of the market pretty actively as we speak. That could be huge for Spirasoft. That could be a lot of the growth right there. So if I take the midpoint of the revenue growth guidance, which I don't think is overly aggressive, I take their EBITDA margins guidance, which are frankly probably overly conservative. I basically back into a situation where their EPS is compounding 24% a year the next 5 years. So that's a 24% return in the next 5 years if they don't, get any kind of revaluation or multiple. Here's the thing, they're aiming for a foreign exchange listing in 2027. So I would say that if they accomplish that and they accomplish that in this kind of growth, I would sincerely doubt that they're going to be valued 16 times. And if they go to the London, US market, something like that. So that would add accordingly the 24% per annum return. So threw in some risk here. I'm not trying to get every risk on the slide, but I want to put a few that kind of really stick out to me and that put some concern in the back of my mind. First one's on customer concentration. They last disclosed the data on that in 2020. It was in a prospectus. We believe it's come down since. We think it's closer to 10 to 15% for the top 2 customers each, 20 to 30% collectively. But we've requested that management disclose this quarterly, annually, whatever, but begin disclosing this again. Hopefully that happens. But in the end of the day, that's clearly a risk, and we seek to mitigate that risk at PFH in part through position sizing and just trying to be a little bit conservative with our growth assumptions. On the second item, well over 80% of their headcount's in Poland. That's actually their advantage right now, but that a short-term advantage can become a long-term risk. And I think it is a long-term risk. They're selling to places like the UK and Germany. They're selling in pounds and euros. And, if the Polish economy outperforms Western Europe's, we should expect its labor costs to go up, its currency maybe to outpace those currencies. And, it would ultimately make them a little bit less competitive on a cost basis. Just on that last item, insiders own 85%. That's also a good thing. But, it's a good thing until it's a bad thing. And it's a bad thing if they ever decide to mistreat us minority shareholders. No indications of that based on how they compensate themselves, based on how they performed. They have a clear exit strategy here in 2027. But we're along for the ride. So that's a risk to keep in mind. And this is a disclosure. I'm sure Ian doesn't want me to read through this, and I won't. You're all welcome to come back and pause it and read it if you enjoy this sort of stuff later. So let me just move on to Q&A. Back on schedule, Ian.
All right. Thank you, Tom.
Yep.
We don't have any questions that came in quite yet. If anybody has any questions, feel free to reach out to Tom directly on Microcap Club or through any other communication channel.
So I just clicked on them. I see one that
Okay.
came in here. Typical customer profile. They have quite a few automotive. They have some people in geo, and we believe that those are primarily Germany and Croatia. They don't disclose the name, so you got to do some scuttlebutt on it. They do geospatial work. They have quite a bit of geospatial stuff up in the UK. They're spread around the industries pretty well. One of their two big customers we suspect is definitely automotive. I see a second question that came in. How can you buy Spearsoft in the US? So they are, we obviously, I mentioned PFH Capital. We try to go in a lot of markets and establish custody arrangements so where most people can't go. This one's actually quite easy to go to. It's part of why I presented this one. If you have an Interactive Brokers account, you can trade them just fine, as far as I know, in Poland. I don't know what other brokers you can find them through, but I know a lot of guys are going to be using Interactive Brokers, and you should be able to trade them just fine there. Let's see, anyone else here? And I'm happy to kill more time, Ian, any way you want. I was going to keep you on schedule here.
That's okay. No, that's all right. No, thanks, Tom. I appreciate the presentation. Very interesting idea. And again, if anybody else has any questions, feel free to reach out to Tom directly.
And I'll post this one up on the Microcap Club as well as an idea. Get a thread going. Put somewhere for you guys to beat me up when it fails in 2 years. So, here we go. Does the steady insider selling worry you? There isn't any that I've seen really. The three major holders are collectively owned. They're probably the three biggest holders are over 80% collectively, and to the extent someone sold a few shares, I mean it's de minimis. To be honest, I wouldn't mind them actually losing a few of their shares just to increase the free float, but I suspect that it's pretty clear that they intend to do some sort of partial exit in 2027 on a foreign exchange to both increase free float and also to diversify out their own personal financial situations. But they don't intend a full exit at that point. Last I've heard. So.
Okay. Thanks, Tom. Appreciate it.
Yep. All right. Yeah, no problem. Thank you guys for having me.
Thank you. Okay, our next presenter is Matthew Martin. Great to see you, Matthew.
I am. I'll just share my screen. Can you see the screen now?
Looks great.
Perfect. Well, thanks for having me, Jan and Mike. So as Jan said, my name is Matthew Martin. I'm a portfolio manager for the Revemont Microcap Fund. We are based in Montreal, Canada. So a quick disclaimer before I start, this presentation is for informational purposes only. These are not recommendations or investment advice. And if I talk about companies, which I will, Revemont may hold positions and may trade on these positions at any time without prior notice. So I'll just start by giving you a little bit of background about myself. I started investing in microcap companies about 8 years ago in 2014. And before that, I used to be an online poker player. And so that's where I developed my risk-taking skills, learning how to manage a bankroll, and also, most importantly, learning how to manage my emotions. And so I've been used to dealing with a lot of volatility. And at some point, I was looking for ways to invest my capital. that I had won playing poker. And one of my friends, Philippe Bélanger, who's also a member of the Microcap Club, he was already investing in microcap companies, started about a year before. And so he told me about the strategy, and I instantly figured out that I could develop an edge in this market. So in poker, you're looking to play against weaker players, so you make better decisions than them over the long term, and you end up being a winner. Well, in the stock market, it's the same. If you play against lesser skilled investors, like retail investors or people that do it part-time, that don't have all the time to do their research properly, that's where you can develop an edge. And so I started doing that with no finance background. I didn't study in university. I just started reading books, attending conferences, and speaking with other investors, developing my network. And I would say it took me approximately 2 years to really figure out a winning strategy. And I think that it's something that's pretty unique about my background, is that I really started from a blank slate with no finance background at all. So I just figured out on the ground in my local market in Canada how I could develop a winning strategy from scratch. And in parallel, Philip and I started a blog called The Space Microcaps, which some of you may know. And we shared educational articles and some of our investment ideas to build a public track record. And eventually that led me to start the Remount Microcap Fund in 2018. And in parallel, I also got my CFA charter. So now I have a bit more of the educational background as well. So a quick snapshot about the fund. It currently has 12 million in assets under management. We started with about 5 million initially, 24 positions, and it's fairly concentrated strategy with 51% invested in the top 5 holdings and over 80% invested in the top 15. And in terms of sectors, we're heavily invested in technology and healthcare. So this is a quick presentation, so I'll just go through a sample of some of our most important criteria. So in terms of must-have, we want a company that can compound its value by more than 30% per year. And I know that's a very high bar, and we're very selective, and we won't always be right. So at the portfolio level, if we find a few big winners that can compound their value by that much or more, we should do well over time. And then we look for positive cash flows or a clear path to it. So it's very challenging for microcap companies to get financing, and especially in tough times like right now. And so we want to avoid a refinancing risk. So we want companies that can self-sustain themselves. Then we look for clear competitive advantages. And typically for microcaps, it's in a specific niche of the market. So we want them to have a specific expertise, or maybe a patent, or some kind of regulatory approval, something that makes them unique and hard to replicate for their competitors. And hopefully this small moat can expand over time. And finally, we look for an outstanding management team, ideally with skin in the game. So we always talk with management before investing. We meet a lot of management teams over the course of a year. And if we don't like the management for some reason, or they have a shady past or something, it's a no-go for us. We don't compromise on that. And then a few nice to have. We want a company that's predictable and easy to understand. Just because it makes our lives easier to evaluate them, but also because I think the market eventually pays a premium for companies with those characteristics. So as they grow and they execute, there's a better chance that we get a multiple expansion over time. And then we want to find them undiscovered, with low or no institutional ownership and analyst coverage. And how we're able to do that is by staying small. We only have 12 million of assets under management. we intend on staying a small fund. And so that way we can keep investing in the really, really small microcap companies in Canada and find them before the larger institutions. I think, you know, our criteria are fairly simple. It's a simple strategy, but it's not easy because you get pulled in all directions. There are a lot of investment opportunities out there. I get a lot of ideas from my network, and I think it's hard to stick to your strategy, stick to your criteria, and really know what to avoid. And so we've put a lot of emphasis on figuring out what we should avoid. And so we avoid natural resources because I don't like the commodity risk. So that's about 2/3 of the Canadian market is natural resources, and we avoid that altogether. Then we avoid pre-revenue or unprofitable companies, again, because we don't want the financing risk. We avoid story stocks with no track record. And for those who know a little bit about the Canadian market, once every couple of years, we get a big trend, big fad, like we had cannabis and blockchain and plant-based foods and things like that. And so when there's a big trend like that, a lot of companies are looking to go public and raise capital based on mostly stories. And initially they perform well when the bubble is inflating, but then inevitably they all come crashing down. And so we just try to avoid those fads. Then we avoid roll-ups, and it's a lesson I learned the hard way. And we still own a large position in the roll-up, but I realized over the years that executing a roll-up strategy as a microcap company is very challenging because you are always needing to raise more capital, and if you don't have a good multiple in your stock price, it's not attractive to do so, and so your growth is slower, it doesn't excite the market as much, and so it's very challenging to execute this as a microcap, and I haven't seen a lot of examples where companies have been successful doing that. And finally, we avoid, for the most part, IPOs and RTOs because typically the financial forecasts and expectations are inflated. And I've studied our track record investing in IPOs and RTOs, and almost every time we would have been able to buy the stock or cheaper with better fundamentals within the next couple of years after we went public. So let's move on to my current topic. The company is called Microcaps Biosystems, MBX, on the TSX. It's about a $74 million market cap company, and full disclosure, we own it in our fund. It's actually our largest position. So what they do is they are infectious disease testing specialists. And it's not, unfortunately, it's not a very simple business to understand at first. And I'll try to run through it quickly, so bear with me. The company started about 30 years ago. And for most of its life, what they did is native antigen production. So the first point on the left. So an antigen is the ingredient that goes into a diagnostic test. So for example, you do a COVID-19 rapid test. The ingredient that's inside the test that will react if you have the disease is called an antigen. And so Microcaps manufactures antigens for many different diseases, for many different test makers. And so it's a key ingredient that goes into the test. It's a small input for a very small cost, but a very important piece of the test. And so that's why they are able to have pricing power. The flip side, what's unfortunate about this business is that it's a slow growth industry, mid-single digit market growth, and it's a small market. And so Microcaps used to do 12 million in revenue in 2019, and then COVID happened, and a lot of the testing capacity worldwide was repurposed for COVID testing. And so some other tests were impacted, and the revenues declined to about 8 million this year. We think this will recover eventually in the next few years and should resume growth at mid-single-digit rate. Then in 2017, a new management team came in, a new CEO actually came in, and he looked at this business and the expertise they have in producing antigens for multiple decades. And he said, what can we do with this? How can we leverage this expertise to develop new business lines? And so the first thing they did is they developed a new business line called CAPS, or Quality Assurance Products. Now, instead of manufacturing the antigens that goes into the test, they do a quality control product for laboratories that run the tests. And so, for example, every 25 to 50 tests that a lab will run, they can use a Microcaps quality assurance product to test if their equipment is working properly. So they will input a known positive sample and a known negative sample and make sure to get the right result. If it's not the case, they know the equipment is not working and they've been providing wrong results to the patients. And so they started selling those products in 2019. They did about $1 million in revenue, and now they're up to $6 million in revenue this year. And they just announced a new contract for $5 million more going into next year. And so I believe this business should do well over $10 million in revenue next year. So this is a very fast growing business, and it is the main growth opportunity. If you look at Microcaps today, I think this could be several tens of millions of dollars of revenue over time. And finally, the third business line, when COVID started, there was a lot of testing for COVID, and one piece of a test that's really important is the small vial of liquid. So when you get the swab in your nose, they put it in a vial of liquid to stabilize the sample before it gets sent to the lab. This small vial of liquid is a regulated medical device. Most of them are in Canada. Actually, most of these devices are imported from Europe or Asia, and there are no domestic suppliers of this in Canada. And so the province of Ontario approached Microcaps. They said, you have the expertise to manufacture that. We'll give you a grant, build a manufacturing facility, and supply us. And so Microcaps did that in a few months. They set up the manufacturing facility, and they've been generating about $5 million in revenue from that, just selling to the government of Ontario in the last couple of years. And now they're expanding their capacity to be able to sell to other provinces as well. So it's a competitive market, and there might be oversupply at some point in the future as COVID testing declines. But we think that being the only domestic supplier in Canada is an attractive value proposition, and they should maintain a good market share here in Canada, but it will be lumpy. So I'll just run through my criteria that I mentioned previously to help you understand why I like this opportunity. So in terms of compounding, their revenue grew 77% last year, and EBITDA grew over 1,000%. So there is fast growth and operating leverage, and I think the fast growth can continue with the CAPS division. And it's also trading at less than 15 times EBITDA. So we have the potential to see a multiple expansion over time if they execute well. Then the company is profitable. They generate over 20%, 25% actually EBITDA margins. They have competitive advantages. First of all, the expertise that they developed over the last 30 years is quite unique. It's also a highly regulated industry. So they have ISO certifications and regulatory licenses to operate because they work with live viruses and bacteria. So it's something that would be tough to replicate for a competitor. And finally, they have some intellectual property that they develop in-house, and also they license some unique IP from partners. And finally, the management team is outstanding, in my opinion. I've met with the CEO multiple times, and I think he has a lot of intelligent, fanatic characteristics. If you just listen to some of the earning calls, you should understand why I think that. And lastly, in terms of nice to have, unfortunately, the company is not super predictable as of now, but it's getting better, it's improving. It's still a bit lumpy, but as they sign more long-term contracts, multi-year contracts for caps, I think this business will become more and more predictable. And it's also, unfortunately, I think not so easy to understand, but if you spend enough time, I think it's quite possible to gain a very good understanding of the business. And lastly, it's not undiscovered per se. It's been around for a long time. They've been public for, I believe, 20 years, but they've always failed to generate enough revenue growth to really get investors excited. Previous management also invested in some projects that didn't pan out and that basically destroyed shareholder value. And so I think it has a bad reputation. And hopefully under the new management team with a renewed growth strategy, they can execute and get rediscovered again by investors. So that's pretty much it. If I don't know if we have time for questions. If anybody wants to reach out, please feel free to do so. And I'm also a blacklist on the Microcap Club.
Thanks, Matthew. Maybe we have time for a couple. I'll just ask one quickly. Have they commented at all about sort of the tail on the COVID kind of opportunity on the business?
Yeah, well, I think one of the misconceptions about the business is that they are really COVID related, and they had some revenue increases due to COVID because they sold some caps and also the XTM, the small vials of liquid are related to COVID. It's hard to tell exactly how it will play out. It should decline over time, but some other parts of their business have been impacted by COVID as well, like the Intigen business declined 4 million due to COVID. It should recover eventually if COVID declines. So I think all in all, I would say give or take should be fairly similar. If COVID declines, the other parts of the business should increase enough to offset it, and you still get the growth opportunity in caps, which is unrelated to COVID going forward.
Mm-hmm. Okay. Well, thanks. I don't think we have any other questions. If anybody else has a question, Michael or Matthew has his contact information up on the screen. Feel free to contact him directly. Matthew, thanks for participating.
Thanks for having me, Jan.
Okay, our next presenter is Jason Hirschman.
Thank you, Ian. Let me see if I can just share my screen here. Let's see. Okay. I think everybody's seen my my PowerPoint. Is that correct, Ian?
Yeah.
Great. Then I'll just I'll get into it. Okay, my name is Jason Hirschman, and today I will be discussing both my investment strategy and the merits of Goldberg & Janssen, a small Swedish microcap. Before I tell you a little bit about myself, let's talk about who I don't want to be. I don't want to be beaten by some casual investor who spells Buffett with one T, some guy who spends 7 minutes a year on his investment portfolio in between picks on NFL draft day, some guy who buys stocks with cool products his bros love. But because he just lets them alone, one of them goes fantastically nonlinear after 7 years of ownership. Who wants to lose to this person? Well, we serious microcap investors can't control random luck. But at the very least, we can control our own behavior. We should not defeat ourselves. Yet we so often defeat ourselves because hard work and dedication and checklists and channel checks and management calls spur us to overact, because we forget that the purpose of research is most often not to buy, because we accept mediocrity because it's new mediocrity. Now, a little bit about my background. I'm a full-time investor now, but for 25 years, I was also a full-time business owner. Most of my investing approach comes from hands-on management experience, working with demanding customers, with suppliers in China and Korea, product development, and business lawsuit experience. I've said this before, but there is a big difference between swimming competitively or reading a book about competitive swimming. When you're in the water, you understand how special the better business truly is. What I really prefer are investment setups where the problem is outside of daily operations. This is the dumb cousin to the distressed debt, good business, bad balance sheet, loan to own strategy. If I can make money from a management team not having to change, that's awesome. What I want is perception to change as management executes. Now, many investors want easy to understand stories, the classic elevator pitch. In contrast, I want a tough pitch today that can morph into a much easier pitch because business success makes perceived problems melt away. Not to say that I'm looking for complexity. Complex businesses tend to stay complex. I'm looking for something or someone unusual or weird that could be later be interpreted as special or genius. Now, throw away your emotional support checklist when hunting huge multi-baggers. It's not going to help. One challenge with huge multi-baggers is that they often don't match conventional patterns you find in typical checklists. Even in microcap land, if it's a good match for checklists or screens, it's probably already attracted a lot of attention. Investors love chasing past success, past winning patterns. Investors looking for consensus, qualitative or quantitative factors fishing crowded ponds. You have to get comfortable with the uncomfortable, the different, the immature. Now, it amazes me how often investors treat microcap investing like small cap investing. Investors love predictable businesses and pay a premium for those types of businesses. But in microcaps, what can appear unpredictable may just be a side effect of too few resources at the current time. How many resources does a microcap spend today for internal controls, reporting, financial analysis? Low reporting quality for operations or shareholders can effectively mask the intrinsic quality of a business. It can camouflage the true abilities of top management. The issue is wider than just internal controls or reporting. Microcaps, particularly nanocaps, are often undermanned versions of Adam Smith's pin factory, in which 18 distinct operations are performed by many distinct hands. As microcap CEOs carve out specific functions, like sales and marketing, from their direct participation, we have an early view in how a young company may successfully or unsuccessfully handle further specialization. All of this affects not only the results, but the perception of the business in the eyes of your fellow investors. Instead of asking a CEO what he's doing more of, I like to inquire what he's personally doing less of. Then you have to hold on to the eventual multi-bagger. How do you do it? One way is to consciously resist recency bias. As investors, we're suckers for new information, new data, the most recent quarterly results, a nugget from that last chat with the CEO. But is it news or is it noise? Why do we weigh the most recent so heavily, especially when we know progress is not linear in microcaps, and it's often 2 steps forward, 1 step backward? My approach is to be skeptical when the most recent opinion strongly deviates from the average of multiple previous opinions. It's all about staying in a great stock and not selling out prematurely. It's too hard to get back in at a substantially higher price. Few people can do it. Let's take a closer look at 2 investments of mine that I filed 13 Gs, Expel and Liat. Here are 2 wishes I have for you. May all your dreams come true, and may all your strong opinions be lightly held. Follow the second, and the first is a cinch. I have to admit that my first opinion of Expel was that paint protection film seemed like a silly rich man's niche product, a high-priced car condom. Thank goodness I have a strong network of investor friends, friends with financial benefits, and the inclination to find the answers to the crucial whys. When you see something that works, even if it seems weird or silly, you have to find out why. Actually, especially if it seems weird or silly. It's important to note that Expel never lost a lot of money under Ryan Pape since their flirtation with bankruptcy, and never resorted to chronic share secondaries. It's also fun to see how the perception of Ryan as CEO has morphed from better than average to superstar, as he's built a larger, effective team around himself. Today, Liat sells head-to-toe motocross and bicycle protection and accessories. When I first got involved, their predominant product was a neck brace for riders. It looks like a toilet bowl seat you put around your neck. Somehow, this company was going to expand beyond technical toilet seats to fashion-forward segments of the rider market, yet they did it. What is personally humbling to me is at the same time I was making perhaps the most crucial decisions of my investment career, to hold my Expel shares after they quadrupled and more, post the 3M lawsuit and a quality control problem, I also made perhaps the worst investment decision of my career. You see, I owned more than 5% of Liat, selling out in late 2018 and early 2019. Less than 3 years later, Liat is a near 10-bagger from that sell price. Now, how can one simultaneously make the best and worst decisions of one's investment career? Perhaps it's understandable, but instead of evaluating Liat's improvement on an absolute level, I kept comparing its progress with Expel. It was an unfair, unnecessary, and ultimately costly comparison. Liat was priced for anything but great success, so I had the luxury of waiting, but my own impatience, unreasonable demands, and false narratives cost me more than $7 million of gains, an expensive lesson. Okay, it's time for a stock pitch. Let's talk about Goldberg and Janssen. This company has a ridiculous name, I know. It sounds like an ambulance-chasing law firm. Goldberg and Janssen is the kind of company I like. Superior business model, economics, and management held back by a combination of temporary factors and current investor anxiety. Goldberg and Janssen focuses on serving two markets in Sweden and the Nordics. The historic core business are pool accessories in Sweden. Now they're adding additional products for the upscale home and garden consumer and a service offering, which is very exciting. In 2021, Goldberg purchased Numeco AB, a distributor of electric light work vehicles in Sweden, Denmark, and Norway. Since then, they've added the regional distributor rights to other environmentally friendly commercial work products. Now, many microcap investors are familiar with Bioscience and Paladin, which built impressive businesses in licensing drugs for Canada. In licensing can take many shapes. Combining a strong marketing organization with proven products is always a powerful formula. Okay, some key figures. Goldberg and Janssen did 435 million Swedish krona, SEK, trailing 12 months, roughly equivalent to $41 million US. EV to EBITDA is less than 6, yet the company prints a 40% ROIC. If you include the intangibles, and closer to 100% if you subtract them. The free cash flow yield is about 10%. Clearly, the market is pricing this company as a COVID-19 play, massively overvalued. Now, for the first time, Mr. Market and I respectfully disagree. Goldberg and Janssen's bread and butter have been pool heat pumps and pool roof enclosures. Many of us in North America are familiar with pool gas heaters. Those bad boys use propane or natural gas to quickly heat pools regardless of the ambient temperature. Pool heat pumps need the ambient temperature above 50 degrees Fahrenheit and heat the pool slowly over a couple of days. However, they're much more energy efficient and they produce no carbon dioxide, so they're much better for the environment. Goldberg and Janssen are the premium priced models, and they are the leader in their market. The first to use R32 refrigerant in Sweden, and they offer excellent support and service to pool installers and pool owners. It's a key attribute of the Goldberg and Janssen story, offering better service and support. According to management, more than 80% of new pools in Sweden use some kind of pool heating product. The second largest component of their pool business are high-end pool enclosures. The rest are pool covers, liners, robots, etc. The company is also going to introduce a new line of pool products for next season, but it's a secret for now. It's important to note that in-ground pools are not like jacuzzis or cheap metal above-ground pools. During COVID, the jacuzzi market exploded in Sweden, and many pool retailers are doing a 50-50 mix between jacuzzis and pools. Now retailers are doing close to a 5-95 mix between jacuzzi and pools. Middle pool sales have dived too. In-ground pools are much more expensive, $35,000 and higher. They take planning and permits and often experience a construction backlog. It's a major commitment. The jacuzzi market was a COVID-19 bump and is suffering terribly from higher energy prices in Sweden. Fortunately, the nature of the commitment and customer demographics insulates Goldberg & Janssen from a higher percentage of the COVID-19 and energy inflation distortions. There are definite headwinds at the moment, but Mr. Market may be throwing out the Swedish baby with the pool water, so to speak. I know what you're thinking. How can the pool season in Sweden last from May to September? The Gulf Stream affects the bottom half of Sweden, creating milder temperatures than what would be expected given Sweden's northern latitude. Fortunately, most of the population and almost all of the pool market is in the bottom half. It's not Florida or Nevada, but mild summers and lots of summer daylight allow for a respectable pool market. Goldberg & Janssen's Nomeco division is an example of what I label second wave electrification. There's no denying a secular wave towards climate sensitivity and lower greenhouse emissions. In North America, we often view Tesla and other emerging auto companies as the way to bet on electrification. Here's another way to profit from it: the phase out of diesel and petrol work vehicles, power tools, industrial mowers, and chemical weed control. Selling to municipalities and nonprofits are also a nice way to hedge some pool market volatility. People, you don't have to pay 10 times revenue to ride an electrification wave. You can barely pay more than one-time revenue for this company and get real profits. There's no doubt that Goldberg & Janssen has benefited to a degree from a COVID-19 tailwind. First level thinking is repelled by over-earning plays. Second level thinking asks how fast a company can power through that challenge. Even with higher interest rates, even with higher energy prices, this company has a lot of irons in the fire to overcome some pool business headwinds. Now, GJAB, Goldberg & Janssen, is switching to IFRS in the third quarter. So these trailing 12-month earning numbers include substantial acquisition amortization. The numbers are better, even if you exclude them. Plus, management did 2 price increases, May and July, which will help too. It just takes time for the increase to filter through in their model because the commitments to buyers last year were building their pools this year. For what it's worth, management is not seeing much weakness in their pool business, in their core pool business as of yet. Now, if you've heard me pitch Galaxy Gaming in the past, you know I really like high gross margins. But you know what? I really like moderate gross margins too, when they're paired with the right business and market economics. Selling a product that is a modest percentage of the overall purchase price to higher end customers through distributors and offering them great service and support. Combine that with an asset-light balance sheet and strong management. Well, that's a setup I know and like very, very much. Here's a Mark Andreessen inspired slide. Microcaps are too small to have true moats, but I like the idea of defensibility. I particularly like distribution defensibility. How often do we hear about a microcap legitimately staking claim to distribution leadership? It's almost always a supposed better product or service that needs to displace a larger established competitor. One thing I've learned from studying Excel is that customers who think you're fun and competent stick with you. If you can make automotive plastic film or pool heat pumps fun for your direct customer, that says something. Okay, so what is this company worth? What kind of upside is possible? Well, if you're a Euro or Krona Uber bear, If you think the housing market is going to collapse, if you think Europe is doomed, this isn't the stock for you. If you don't want to patiently chip away at a position, if you need to buy $3 million of the stock, this is too illiquid and too small a float for you. Only a handful of you can join me on this journey. If you prefer an Excel model, which is precisely wrong, rather than a back of the envelope calculation, which may be roughly right, Goldberg & Janssen is not for you. With apologies to British design guru Paul Bennett, successful microcap investing can be characterized as a, quote, fleeting glimpse of the bleeding obvious. Microcap investing offers us soft clues, any of which can be dismissed, but collectively can be powerful indicators. Students of investing know that the pool industry has been a wellspring of previous multi-baggers like distribution giant PoolCorp in the USA and pool robot maker Matronics in Israel. Goldberg & Janssen is leveraging its pool industry connections to widen distribution of the Oak-Fire grill. We see the initial fruits of Nordic Relax spas being installed near GJAB's headquarters. More crucially, Nomeko is now marketing the Oleotech weed control and Ultra electric mower machinery at Green Roadshow locations in Sweden and to existing customers. I think we'll know inside of a year whether these new divisions and products are successful and get a better sense of how successful. Admittedly, the extent of the COVID-19 bounce, energy inflation, and a softer housing market in Sweden complicates matters. But behind the fog of near-term macro issues is a very profitable business trading at a low multiple given its economics. Look, it's a scary moment for housing-related industries given higher interest rates and energy prices. But the pool business is historically a great market. People will want pools in the future. They will want their pool water to be temperate and comfortable, and they will want their pools covered. There are a lot of shots on goal. There's a lot of optionality. The way I look at it, 2023, and to a lesser degree, 2024, could be challenging for the pool side of the business, but momentum in the professional green space, the electric work vehicles, is going to be helpful. I am expecting a roughly 50-50 split between pool revenue and everything else in 2025, or a bit later, depending on the economy. Even without the benefit of further acquisitions, which I think are likely, or a shift from the Spotlight Exchange, which could happen in a couple of years, I see a lot of upside for investors. Right now, this seems like a strange business. Give it a few more years. We'll be referring to Goldberg & Janssen as a special business. Now, thank you for listening to my presentation today. Feel free to reach out to me on Twitter, Microcap Club, or email. Thanks again.
Thanks, Jason. I got a quick question for you. We have about a minute left. How did you find this idea? Trades on some far off exchange on the Spotlight Exchange over there. How did you originally find it? And how did you start building conviction kind of in a new geography like that, around the business and management team as well?
Well, I've been following a number of Swedish fin Twitters for a while, and any kind of Swedish ticker that's dropped, I just take a quick look and see. Then that's the way I found the Spotlight Exchange and happened to find Goldberg & Janssen.
Okay.
But in terms of finding conviction, it's a little difficult because it's an entirely different geography, different culture. So I haven't really been able to do too many channel checks because of the language. But it is. I have talked to of course, the CEO. I've talked to the chairman. I've talked to a few other people. The Swedes actually disclose a lot of information, even for some private companies, which are retail facing. They have to disclose their revenue and profitability and give a little bit of a statement about conditions. So there are websites that can help with that. So it's not the largest position for me, but it is one I'm very enthusiastic about.
Yeah, it was a great presentation. And yeah, thanks for presenting the company. It's really unique.
No, absolutely. You're welcome.
Thank you.
Mm-hmm.
Our next presenter is Jordan. Jordan, are you with us?
I'm with you. Can you hear me?
I can hear you.
Perfect. Let me share my screen with you. All right. Can you see it okay, Ian?
I can see it. Looks good.
Perfect. Well, thank you. First, Ian, I want to say thank you for having me. I'm thankful to be a part of the community and to network and build relationships with other investors, many of whom have become my friends. And I want to give a little bit of background on Pinnacle and myself, and then we can dive into our investment process and finish with a stock pitch of Quest. Starting with Pinnacle, Pinnacle was a hedge fund for 17 years from 94 to 2010. And Pinnacle had exceptional performance over that time period and averaged 24.11 net annually with one down year in 08. And Pinnacle closed to outside money in 2010 and became a family office, and it's been a family office ever since. The PM of the hedge fund, Barry Kitt, wanted more quality of life, but he didn't slow down at all, and he works just as hard today as he did back then. In 2014, Greg Kitt had finished cutting his teeth at a hedge fund in San Diego, and he came to join Pinnacle. And then lastly, I've had the privilege of working with Pinnacle since January of 2019. And today, Barry, Greg, and I run our investment portfolio. What a good place to start, I think, when we're going to talk about our process is how do you find ideas? And so I would love to say that this is easy, but at least for us, it takes a lot of work. There are generally three ways that we find ideas. First, we take a lot of meetings. Every year since joining Pinnacle, we've taken over 300 unique meetings with publicly traded companies. So we turn over a lot of rocks. It's been incredibly helpful in building out a library of knowledge for industries, for business models, for competitive landscapes, et cetera. And so before every meeting, we build out a stub model and we create a list of questions. And then after every meeting, hopefully we underwrite the investment opportunity. Second, I love monitoring the syndicate calendar, which has been an incredible idea generator for us. We participate in IPOs and follow-on offerings. And historically, that's been the number one idea generator for us. Obviously, the syndicate calendar has been very quiet this year. But third, lastly, when we meet with and subsequently underwrite a company, we frequently will find a great company or a good company with a great management team that just has an expensive price. And so what we do is we monitor those companies consistently with the hopes that we can get involved at a better price. And so let's talk about how we analyze the companies that we do find. So generally, I like to say we're trying to find great businesses with great management teams at a great price. I have the most to say in this context about great businesses and great prices, but regarding great management teams, we're looking for people of integrity. And that seems obvious, but that's hard to evaluate without spending time with management. It also probably can't be done in one sitting. And so we evaluate management teams by spending a lot of time with them and by trying to gauge how well what they say aligns with the numbers that they're reporting. And then for great businesses, everyone on our team has a slightly different process for analyzing businesses. I want to share mine and a tool that my colleague uses has been so helpful to me. But you'll see this question on FinTwit frequently, but someone will inevitably ask, if you could ask a management team just one question, what would it be? And I'm going to cheat and I'm going to say that I have two. The first thing that I want to understand is a company's value proposition relative to the competition. That's super obvious, but it helps us understand why companies grow and take share. And we try to own companies that are the best at what they do or have something about them that uniquely positions them in their competitive landscape. As it pertains to the unit economics, which is the second thing I want to understand, I want to understand the economics for all the parties in the ecosystem, principally the customer and the company. For the customer, the unit economics are important to assess the value proposition, obviously. I want to know what the product or service costs the customer. Does it save the customer money? How does that compare to the competition? And, if we're going to purchase something as a customer, is there a return on that investment? And then unit economics for a company are also important because I want to understand the incrementals of the model. So we love investing in businesses with high incremental EBITDA margins. And so understanding the unit economics is really important to that. I want to share a little bit of a mnemonic device for our process. The acronym is MERIT. It's super easy to remember because we're looking for investments that have merit. And so one thing to add here is that there's no order or ranking. It's just the way it's spelled. And so if I can dive through it real quick, M is macro. So overarching trend in the industry driving growth. E is estimate. So how is consensus positioned relative to our model? R is relative valuation. Is there room for multiple expansion relative to comps? Intrinsic valuation, is the multiple that we're underwriting with cheap on an absolute basis? And T is trackable. So the best advantage that you could have is an information advantage. And so can we find a public data set that allows us to track the company's performance intra-quarter? And then S is safety. So do we trust the management team? So if we can find strong industry tailwinds, consensus estimates that it seem conservatively modeled, the business trades at a discount to comps, and you're underwriting with a reasonable multiple and you feel like you can trust the management team, that's a great business to own, and I will take 10 of those. In terms of assessing great price, as I mentioned, we like to think about valuation on a relative and absolute basis. We keep an underwriting sheet for all of our investments and all the positions that we monitor most closely on our watch list. And we underwrite to a 40% IRR just because stuff happens in small cap land. And so on the next slide, I have a screenshot of our underwriting sheet. This is it. This is helpful for me just to garner the necessary conviction to initiate on positions and stick with them. And we generally underwrite on profitability. In this case, as you can see, a lot of EBITDA 2 years out. And so that's a perfect segue to our stock pitch. I mentioned that we underwrite on EBITDA 2 years out. And so to get everyone's attention up front on the pitch, we think this stock is worth $25 on 24 EBITDA or $21 on a diluted basis. That's a 78% and 64% IRR respectively. And to go one step further, if Quest can grow gross profit dollars 10% or annually and get reasonable multiple expansion, then this is a 10 bagger in 12 years. And that's really exciting to me. So let's dive into that. So first, who is Quest and what do they do? Quest is an asset-light, value-added waste and recycling services provider. Quest helps national customers meet internally mandated and or externally regulated ESG goals at no incremental cost to the incumbent waste management solution. So Quest is asset-light, like I said. It has a network of 3,500 independent waste hauler partners. Quest doesn't own any waste hauling trucks or haul any waste itself. It's asset-light. So Quest earns the difference between what customers pay Quest and then what Quest pays the waste haulers. Because of that dynamic, we like to think of their gross profit line as net revenue. And then importantly, Quest will provide waste volumes and sustainability data back to the customer to inform three things: internal analysis, ESG reporting, and then external regulatory reporting. So now that you know what they do, let me give you some history. Prior to 2016, Quest was growing for the sake of growth, little focus on profitability. Quest had millions of dollars of negative gross margin revenue. In 2016, Ray Hatch, Quest's current CEO, joined. And when he joined, he embarked on a mission to eliminate negative gross margin revenue and position the company for profitable growth. From 2016 to 2020, as you can see in this picture, revenues were almost cut in half, but gross profit dollars grew from 14.4 million to 19.1 million. And EBITDA dollars grew from negative 1.5 million to positive 4.5 million in 2020. Quest grew organically for the first time under Ray's leadership in Q4 of 2020 after shedding all of this contractual multi-year negative gross margin contracts. Today, Quest is currently growing gross profit dollars 22% organically first half over first half. So let's talk about the macro trend that's driving that. The key trend here is landfill diversion. So what's landfill diversion? Why is it a big deal? When your trash gets picked up, and even when a lot of your recycling gets picked up, it ends up in the landfill. There are a lot of reasons for this, but principally, the asset-heavy companies, affectionately known as the Big Three, Waste Management, Republic, Waste Connections, they all own landfills. And when haulers take waste to the landfill charges tipping fees that have 45 to 70% EBITDA margins. Those margins are much higher than any other segment of their business. And so they have a lot of incentive to continue to take waste to the landfill. However, states are increasingly regulating what you can and can't send to the landfill. This isn't just a California thing. It's being done in other states across the country. For example, if I can just take one of the over 100 waste streams that Quest manages, let's take food waste, for example. There are at least 8 states that have restrictions on sending food waste to the landfill. So why are states doing this? First, landfills are the third largest producer of methane gas. And second, when landfills get rained on, it creates wastewater. And what you don't want is for wastewater, which has harmful chemicals referred to as PFAS, you don't want that wastewater to seep into groundwater and your rivers because it gets in the crops that we ultimately end up consuming. And that's why states are regulating landfill use. So in addition to regulatory drivers, companies have taken it upon themselves to divert waste away from the landfill. I'm sure that we've all seen companies issue their inaugural ESG reports over the last couple of years. And one of the key items in an ESG report is landfill diversion. And so now that you get the big picture theme, let's talk about the value proposition for every member of the ecosystem, starting with the customer. So Quest customers get at least 5 benefits from working with Quest that all come, again, at no incremental cost to working with the asset-heavy competition. And so first, Quest is aligned with their customer. Quest doesn't own any landfills, so Quest doesn't have the incentive to take everything to the landfill. They have the incentive to meet the customer's needs. Second, Quest performs waste audits at customer locations. Quest will right-size waste pickups by changing the size of the waste container or the frequency of the pickup to reduce service costs. And so reduced waste pickup frequency results in cost savings to the customer. And then thirdly, and this is really key, Quest will compile waste volume data and provide comprehensive reports by waste stream back to the customer. And again, companies use this for the 3 things we talked about. Internal analysis. Let's give an example. Let's take Quest customer Kroger as the example and take 2 grocery stores that are the same size. Why is one grocery store generating more waste than another? Does one store have too much inventory? Are they over inventory? Or do they have too little inventory? Do they have a spoilage problem? Do they have a busted fridge that's causing that spoilage problem? And that's manifesting itself in the waste data. Other 2 ways companies use this data, they'll use it to inform their ESG reports, and then they'll use it to show regulators that they're meeting the regulatory requirements. Fourth and fifth here, the customer benefits from vendor consolidation. Frequently, companies work with numerous vendors to meet all of their recycling and waste needs. Quest, if you'll excuse the expression, is one throat to choke. And then fifth, Quest will share salvage value of commodities with the customer. So that's the customer. What does the hauler get out of this? The most expensive thing a waste hauler can haul is air. Why is that? Well, waste haulers have a high fixed cost business and they get paid on volume. So Quest has a symbiotic relationship with their haulers. Quest can bid for contracts nationally that small mom and pop regional haulers could never bid for. Quest gives haulers business they'd never win on their own at really high incremental margins because Quest is going to increase their utilization and their route density. In return, the hauler is going to give Quest preferential pricing. So what does Quest get out of it? Quest gets a recurring revenue stream. It's highly sticky. That revenue stream is going to increase hauler utilization, and that allows Quest to get better pricing. So to some extent, this creates a virtuous cycle. And so now that we have the macro backdrop and understand Quest value proposition, let's switch to Quest growth algorithm, consensus expectations, and the unit economics. So Quest has a 3-legged stool for growth, as they like to describe it. It's expanding with current customers, winning new customers, and growing through acquisitions. With their current customers, Quest grows through increased volumes, cross-selling additional waste streams and services. Quest also has been very successful at winning new business and has announced several 7-figure and 8-figure revenue wins over the last year and a half. Additionally, Quest has grown through acquisitions. Quest team is very adept at structuring acquisitions and organically growing the acquired business by cross-selling waste streams to the acquired customer base and then by adding additional geographies. On the unit economics side, real big picture, Quest average customers 7 figures of revenue that contributes mid to high teens gross margins with 50% of incremental gross profit dollars flowing through to adjusted EBITDA. So this model is all about gross profit dollar growth, and then 50% of incremental gross profit dollars flow through to adjusted EBITDA. Briefly on the consensus expectations, again, Quest is currently growing gross profit dollars over 20% organically. Although that might moderate, consensus expectations currently call for 7.7% gross profit dollar growth in 23 and 24. Additionally, like I said, 50% of incremental gross profit dollars flow through to adjusted EBITDA. but consensus implies only 32.5% in 23 and 7% in 24. I think those estimates are positioned super favorably for Quest. So let's cover the valuation next. There are two ways to think about comps here. First, you can comp it against other waste service companies. There are 8 publicly traded asset-heavy waste services companies. I don't think this comp set is very instructive for 2 reasons, principally. The business models are completely different. One's asset-heavy, one's asset-light. And the asset-heavy players have a secular headwind from landfill diversion versus Quest, which has a secular tailwind. However, if you want to use the asset-heavy waste services companies as a reference point, the big 3, Waste Management, Republic, Waste Connections, those 3 trade at 16.4 times 22 EBITDA and 15 times 23 EBITDA. So in my mind, that creates some baseline for a premium. Second, and our preferred method for thinking about comps is similar business models. So we're looking at other small cap companies, asset-light companies, multi-year contractual customer relationships with high renewal rates that focus on an enterprise level sale with high incremental contribution margins. That comp set that I have here trades at 11.5 times 23 EV to gross profit and 24 times EV to EBITDA. We underwrite this at 20 times EBITDA. It's in the middle of both comp sets. I think that's really defensible. If we apply a 20 times EBITDA multiple to our estimates for 23 and 24, we compute a $22 and $25 price target respectively. A triple in 2 years is much higher than a 40% IRR. It's a 73% IRR. That's really exciting to me. And then lastly, in the way of disclosure, Pinnacle is a 13.1% holder of Quest. I included our disclaimer on the next slide. And with that, Ian, I would gladly take any questions.
Okay, it looks like we have 2 questions that came in. The first one was, what is Ray Hatch's background before joining Quest?
Yeah, Ray Hatch is an operator, and he has been in the industry for a long time. Prior to Quest, he was at a company called Oak Ridge. Hopefully I did that right, but you can check out his LinkedIn. And that company ended up being bought by Waste Management.
Okay.
It's either Oak Ridge or Oak Leaf.
Okay, thank you. And the next question we had was, could you discuss Quest's current cash returns on invested capital?
Yeah, that's a great question. So this is a fun question because in theory, Quest is asset light. And so they have infinite returns on invested capital because it's asset light. So this is like if you want to pull up their cash flow statement, look at the investing section, there's very, very little CapEx.
Okay.
So the invested capital section, there's little investment is my point. Very high ROIC.
Let me see. Got another couple questions that came in. Can you talk through the last piece again? How do you get to 72% IRR from 20% gross profit growth versus expectations?
Yeah, let me a couple questions in there, and so let me just go back to my underwriting sheet. That's easier. And if someone wants to talk through the methodology, I'd be happy to do that offline as well. So you can, this is a little dated from when I actually built the presentation. And so Quest has had a little bit, it's had a little bit of a good move here. And so those IRRs from when I built this presentation are a little high. But the IRR math is simple. And just going back to it, a triple in 2 years is about a 70% IRR. So what's the price you pay today? And then what's the price target? And then back into the IRR over time. Hopefully that answered the question. But if someone wants to spend more time on it, I'd be happy to walk them through it.
Okay. Well, I think we're bouncing up against the time constraint. Thanks, Jordan. It was a great presentation. Thanks for participating.
Perfect. Thank you, Ian. I appreciate it.
Thank you. Okay, our next presenter is Harris Perlman. There he is.
Okay, cool. Thanks, Ian. Everybody hear me?
I can.
All right, let's do it. I do have a presentation. I'm going to wait a moment before I pull it up, just so I can quickly do a quick intro. So I did a couple of podcasts last year. So some of you have already heard a little bit of my spiel, but I am primarily a private investor, and I also manage a little bit of money for some family clients. I'm not really an investment manager in a professional sense. But I used to also be an analyst at a hedge fund, and I've been doing private investing for about 4 or 5 years now, full time. My strategy is probably not terribly different from a bunch of the people you've heard speak already today. I think one thing that makes me a little bit different is that I really am pretty rigorous about profitability for companies. So I really focus on microcaps that are currently profitable, and that's a pretty narrow screen. So it really, for me, comes down to wanting to invest in companies that have proven business models. And it's really hard to have a profitable company without having a functioning business model. So you can always find companies that are pre-revenue or pre-profitability that might have good unit economics at scale. It's just hard to make those decisions and figure that out early in a company's life cycle. And then as far as some other differences from what I do, I probably go towards more industries that other people have avoided. I have done things in commodities. I've owned some oil and gas. I've owned some gold and other mining companies in the past. And for me, it doesn't really come to it's not really coming from wanting to speculate on commodity prices, but just recognizing that all businesses have inputs and risks, and those are just a little bit different and more magnified when you're dealing with commodity companies. So it's something that I've gotten some familiarity with and comfort with. If you followed me on Twitter, at Otter Market on Twitter or on Microcap Club, I've discussed some of those kind of companies in the past. Lastly, I am really not afraid of illiquidity. So I have sometimes invested in very, very small, very liquid companies, order of $10 million market cap kind of companies. And I'm not afraid of building a fairly large stake in some of those companies, even if it might not be possible to exit and to change my mind quickly. So you just have to accept that if you're right or wrong, you're most likely going to deal with the consequences financially of being right or wrong, and not having the ability to change your mind so easily. So with all that being said, I will jump right into my presentation. And let's see if I can figure this out. There we go. So, can everybody see this presentation?
Yeah, it looks good.
Okay, cool. So if you're hoping for a really high quality business, feel free to jump off this call. This is a decent business, Supremex, and it's a company that primarily manufactures envelopes. So, strap in, it's gonna be an exciting presentation for everybody. I can't wait to talk about this company. Quickly, a disclaimer, and this is true for everyone who's been presenting, I'm assuming, but this is not investment advice, and please do your own due diligence. I may have made mistakes in the process of making this presentation. Quick intro. So Supremex, it's a Canadian company, trades in Canada, and it is the dominant manufacturer of envelopes in Canada. It also manufactures and distributes its envelopes in the US. And in recent years, it has been expanding into packaging in Canada. So it's old school company, owns factories or leases factories, and makes products that everybody needs, and makes a good profit along the way. So kind of to whet your appetite for this, why should you be paying attention to this kind of boring sounding company? First off, it's pretty cheap. So you look at their EBITDA numbers, historical enterprise value to EBITDA, it's around 4 times, trailing probably a little lower than that on a go forward basis. So this thing is pretty inexpensive. There's not too much maintenance capex, so there's quite a bit of free cash flow coming off of it. And relative to its historical valuation, it's also at a pretty low price. So this is a reason to pay a little bit of attention and try to figure out if we think this is a decent business to own. And why else it might be interesting to look at it right now. I'll forgive you if you might have missed this major macro trend, but envelope prices have been going up, and this is probably not something people have paid attention to, partly because Supremex is the only publicly traded envelope manufacturer that I'm aware of. And if you look at some of the data provided by this is the Fed data on pricing for categories of paper, the entire paper industry has been experiencing supply chain issues and stresses, and the envelope market specifically has been getting much tighter, and envelope prices have been going up quite a bit even in the last few months. So what is that really being caused by? The company attributes this to actual tightness in the supply-demand balance in envelopes. So you have a business that's historically been relatively, flat to down. It's been shrinking over the last, many years. So there's been consolidation, and some of the competitors have either exited the market or been acquired or taken some capacity offline over time. And as a result, the whole market's gotten pretty tight as demand has kind of recovered a bit from COVID. These are some headlines on the bottom side of the slide of some articles about this envelope crisis. So as you may imagine, envelopes are really not a big input cost when you're dealing with sending mail, but you really need to get them. And so when you need your envelopes, you're going to pay up a little bit if they're in tight supply at the moment. So just by way of furthering that point, one question people might have reasonably is this supply chain tightness just in the whole paper industry? And so is this company actually able to capture any of the margins of that tightness? And the answer, I believe, is yes. And you can see from their recent results, their pricing has been up substantially. It's up over 20% year over year. Their volume is also up, and I'll get into that a little bit over the next couple of slides. But clearly, this is a tightness in the overall envelope market, not simply the paper industry as a whole. And the company's been able to capture increased unit economics from this trend. So the overall market, as I've mentioned, it's, as you probably all intuitively aware, envelopes are not a growing market. And if you look at some relevant statistics, this is a chart that company provides of transactional mail volume in Canada, sort of a proxy for envelope volumes. They've declined at around 6% annually. The US hasn't declined quite that quickly, but either way, it's a declining industry. The key point, I think, is that it's not falling off a cliff. You also can see on this chart, there's been a little bit of a reduction of that decline rate coming out of COVID as some of the demand has bounced back from these industries for sending transactional mail. But this is a market that's sort of a predictable slow decline. The company has talked about some of the things that they've done to mitigate the effect on Supremex itself, and as a result, the company is really not even declining, quite at this rate. So what has the company been doing in this stagnant, declining market? Well, one of the things that they've done effectively is that they've expanded from their core base of operations in Canada into the US. So they have these facilities manufacturing their products in Canada. For those of you who know Canada, almost all the population of Canada is quite close to the southern border against the US. So a lot of these facilities are also very close to parts of the northern United States. So what the company has done is they've done a few strategic acquisitions, but also they've been able to acquire and grow their customer base in the US. And so when they've had shrinking volumes in Canada, because they are the dominant player in Canada with a 85% estimated market share, they're able to use some of that excess capacity as it is freed up into the US market, which they're very small, relatively speaking. They only have around 5% market share. I really attribute this to good blocking and tackling. This is just simply good execution by the management team, I believe, as competitors have been a little bit cautious and gotten out of parts of the market, partly because of COVID. These guys have come in and just done a good job and taken some share in the US, which I think they hope to continue. So another question that I had, which a lot of other people probably would have, is, why is this a decent business? I mean, it sounds very commoditized. It sounds like you should earn really, low returns on your capital. I think a slightly differentiated way of looking at this, which the management team sort of refers to in their presentation, is that this is a regional business. So some investors might be familiar with industries that are known to have really good regional economics because they're truly regional, small industries that you can only have a few competitors in any region. Things like cement, gravel, construction aggregates. So these are industries that might not have too much organic growth, but when you're well established in a certain territory, you can get good economics. And the reason for that is generally because of shipping costs. So anything that's heavy relative to its value, that's going to be a product that has a limited radius of economic delivery. Envelopes are very much in that category. So the company estimates that the effective economic range for their envelopes is roughly at 800 kilometers. So that trend is also probably magnified by higher transportation costs, higher fuel prices, trucking costs are up. And as the markets for these products might shrink and consolidate, also there are fewer competitors in any given region, so it naturally enhances some of those unit economics. To visualize that, this is my rough stab at drawing 800-kilometer circles around these individual manufacturing bases that Supremex has. You can see they really have very good coverage in Canada and in parts of the northeastern US. But it really gives you a sense that they're not going after every customer across North America at this point. They're really they're making money in these core regions where they are they have very good market share. And what are they doing with all the profit that they're making from this decent business? Well, the management team over the last many years at this point now, since around 2015, 2016 or so, they've been buying up some facilities in the packaging space. So things that think about containers for food or beverages, for pharmaceutical products, cartons and boxes. And this is a growing e-commerce related market where the long-term economics might be very good. We don't have the exact figures on the prices, on the earnings multiples they've paid for these acquisitions, but I've done some back of the envelope math. Feel free to do some of your own math around it as well. But I think historically they might have been paying, order of 4 or 5 times EBITDA. It looks like they've spent a little over $40 million to buy up almost all of this business that they now have. And it's on an EBITDA run rate of around $15 million annually right now. So it gives you a sense that it's really not wasteful spending into this new business segment. They've also really focused on a core region of buying up these facilities in Quebec. So it looks like they're taking a sort of measured approach to focus on building a platform that has a good business economics in a certain region before they're going to go out and they're not buying plants all over the place willy-nilly. And on the shareholder side, so who's holding the reins of this thing? There's a really strong large shareholder involved here. It's a trust related to the estate of Jerry Zucker, who you might have come across if you look at some small cap Canadian companies. But Jerry Zucker was a businessman and investor. His estate owns around 23% of the company. And it's also a large, over 10% shareholder in a few of these other companies, which I've provided some of those logos below. I've actually had some personal interaction with these guys back when I invested in a little company called Circa Enterprises. And I had some good, I got a good vibe from some of their people. I felt like they were managing companies conservatively, looking for profitability, looking for return on capital. And I think overall it's probably a good cornerstone shareholder. And the chairman of Supremex is also one of their guys. Lastly, I will point out there was some interesting news early this year. There was a private investor in Canada who disclosed over a 10% stake in the company and pointed out in some public filings that he estimates the company has over $60 million of real estate value in 2 of their facilities, which are owned, and suggested actually in a shareholder proposal at the annual meeting that the company do sale leasebacks for those facilities to free up some cash. And by way of reference, this is over 30% of their enterprise value. Those proposals were not passed by shareholders. However, it's still interesting to think of this as a potential support to the overvaluation and helping to establish a valuation floor and some reduced risk in the overall investment proposition. So I think that's all I've got. Try to keep it short and sweet. If there are any questions, I will say also I have tried to reach out to management. I sent emails and reached out through CFO. I have not heard any response, so I might not have answers to the questions, but feel free if there's anything here.
We had one question that came in. It was, why has the stock price been flat since 2006? Are the reasons, and also what are the reasons for the large write-downs in 2009 and 2010?
So I don't have a good answer for the write-downs. I'm not sure, but I think the market was probably very weak back then, so they probably took some impairment charges. So this company has paid a lot of money back to shareholders over the years. So I think the flat stock price is not a full picture of what the shareholders' returns have been. There have been large distributions. However, I think, big picture here, look, the market had declined, and they used to make some higher margins for periods of time, and the stock just gotten a lot cheaper, I think, over the years. People probably weren't quite as bearish on the long-term trends in the envelope industry 15 years ago as they are today, and I think that's a benefit for people who think there might be upside here. Okay, well, thank you, Harris. Appreciate it. Okay, cool. Thanks, Ian. Thanks a lot for having me on. Yeah. Our next presenter is Michael Melby. Are you there, Michael? There you are.
Yeah, Ian, good morning.
Morning.
How are you today?
Doing great. The floor is yours if you want to share your presentation.
Sounds great. Does everything look okay?
Yeah, looks great.
Well, thank you. Thank you very much for having me on and for the opportunity to present. So excited to tell you a little bit more about Gate City Capital, and then also walk through our investment choice today, which is Unit Corporation. And so to introduce the firm, Gate City Capital is a Chicago-based investment management firm. We seek to provide our investors with attractive, absolute long-term investment returns through the construction of a concentrated portfolio focused on U.S. microcap companies. We construct our portfolio through in-depth fundamental analysis focused on the risk and reward of each investment. And we look for companies trading at a deep discount to intrinsic value. And we also focus on the potential downside of each investment in order to provide an attractive or an appropriate margin of safety. And the firm's name and logo, I'm originally from a small town called Glendive, Montana, which is nicknamed the Gate City. And so in naming the firm, decided to pay reference to where I grew up. Next slide provides our team. It's myself and Chad Kors is our CFO and COO. And then we have both Nicholas Bodner and Harry Sowers as research analysts. Slide 6 shows our investment philosophy. We have some key investment tenets. We focus on buying companies and not stocks. We think of shares as a proportionate ownership of that company, and think of buying a share of that is similar to buying the entire company. We have a long-term investment horizon. We look to invest for a minimum of 2 years when we make any investment. We focus on downside risks and margin of safety. We look to limit the potential capital loss of any investment through an analysis of what can go wrong. We take the time to know the company. We think that information is not free, and by doing the right amount of research work, we can obtain an informational edge over many other investments. We look to evaluate the management team and identify their incentives. We typically look to meet with management teams in person before making any investment. Our portfolio is concentrated. We look to hold under 20 positions. And we also have an alignment of interests. Both myself and the other members of the team have a significant portion of their net worth invested alongside our investment partners. And going to slide 7, it shows the types of companies we look at. We focus on companies with market capitalizations between 10 and 500 million. There's no absolute cap, but find that that's our sweet spot for investing. We look for companies that are headquartered in either the United States or Canada. We like to keep it to areas that we're both familiar with the language and can travel to relatively easily. We look for companies with understandable business models. We're relatively agnostic across industries, but have tended to avoid a lot of tech companies and also financial companies, given some of the investment attributes that we look for. We look for companies generally with lots of debt or lots of cash and little debt. So right now we have 17 portfolio companies, and 14 of the 17 have net cash balances. If a company does have debt, we like them to have both the willingness and ability to repay that debt. We also look for companies with ownership of assets. This can include land, buildings, and equipment. And we find that's attractive both from a margin of safety standpoint and can also be beneficial in an inflationary type environment where we're looking for the value of those assets to also increase in an inflation environment, which creates a natural hedge for any of the companies in our portfolio. And the next slide, slide 8, shows our valuation process. We have a philosophy that the value of a business is derived from the amount of cash that the company is able to generate. And that's where a lot of our focus is on our research side. From a valuation standpoint, we value all of our companies utilizing a discounted cash flow analysis, and with a target price or intrinsic value of the company gained by adding the projected future cash flows of the company with an appropriate discount rate. Our discount rates generally start at 12.5% and can be adjusted upward or maybe downward slightly depending on the nature of the business. We supplement the DCF with a comparable company analysis and to understand how the company's peers are also being valued in the market. And we also utilize a floor value analysis. And this is used to estimate what the business could be worth in the event that all the company's assets are liquidated in an orderly fashion. Slide 9 provides our portfolio construction process. We size each of our positions so the companies with the most attractive risk and return metrics have the highest weights in the portfolio. From a construction standpoint, again, look to hold fewer than 20 positions, the maximum position size of 20%. And we weight our companies based on utilizing both the DCF analysis or intrinsic value to understand our potential upside, and then the floor value or liquidation type analysis to understand our potential downside. For the upside, we look for companies with at least 50% upside for the intrinsic value versus where shares are currently trading. And we like little to no downside based on liquidation value. And we compare the ratio each week in terms of where stocks are trading for a ratio of upside to downside. We realize that's a linear relationship, and perhaps the weightings, or at least we hope the weightings or probabilities of the upside scenario are higher than the downside scenario. But I also tend to think that analysts can be overly optimistic in their projections. And so look for companies with the highest upside to downside ratio and weight those. So companies with the best ratio have the highest weights in our portfolio. And the next slide shows our historical returns. So I founded the firm initially in 2011, and thus far we're pleased to have been able to deliver positive, attractive absolute returns for our investors. We do not look to beat or manage to any outstanding index, but do feel that by following our investment strategy and process, that then provides us with the highest probability of performing well versus any index over an extended period of time. And we're all excited for the future, and realize there's a lot of time and a lot of work to do going forward, but are pleased to have been able to deliver good absolute returns thus far to our investors. So that completes our high-level overview of Gate City Capital Management. The company I'm going to highlight today is one of our largest holdings. It's called Unit Corporation. The ticker is UNTC, Uniform November Tango Charlie. Unit Corporation is an integrated energy company that operates in two segments. Unit Petroleum owns and operates oil and natural gas producing assets in the United States. And Unit Drilling owns and operates 21 onshore drilling rigs. The company previously had a third segment, Unit Midstream, which consisted of a 50% ownership in Superior Pipeline. They continue to own that, but it's no longer consolidated within the company's results, and so is not a direct operating segment at this time. But I'll talk about it more. In Superior Pipeline owns natural gas pipelines and related infrastructure within the U.S. It was founded in 1963. It's headquartered in Tulsa, Oklahoma, has 788 employees. And the company currently has a market cap of approximately $588 million. They have zero debt outstanding. The cash balance is just over $115 million. And after quarter end, Unit made an asset sale and should be getting an additional $43.7 million in cash after quarter end, or an adjusted enterprise value of just below $430 million. For the last 12 months, they've generated $114 million of adjusted EBITDA and $87 million of free cash flow. The company emerged from bankruptcy and began trading in very early in 2021, and thus far has provided a good share price return since exiting bankruptcy. Turning to slide 12, it provides our investment thesis. Unit owns numerous energy related properties and equipment that we think will benefit significantly from current high oil and natural gas price environment. After declaring bankruptcy in May of 2020, Unit shed over $650 million of debt through the bankruptcy process, installed an experienced management team focused on generating free cash flow, while also cutting operational costs and capital expenditures and divesting non-core assets. This is apparent as of Q2 2022. Unit had sold over $100 million in non-core assets, and again, expect to receive a net of $43.7 million after the end of Q2. And combined with very strong free cash flow and asset sales, Unit has utilized that free cash flow appropriately. They've paid down all outstanding debt and now have a net cash balance of $115 million. So basically the balance sheet has been reversed. It has also repurchased over $65 million in common stock since emerging from bankruptcy at what we think are very attractive valuation levels. And we continue to think Unit is attractively valued based on our 2022 forecast. Unit trades at around 3 times enterprise value to EBITDA and has a free cash flow yield based on the market cap, not the enterprise value, of over 22%. So we still see it as very attractively valued. And just going back, we have a price target of it per unit of just over $90 a share, which still provides 51% upside. And next, to give you a little more information on the company's 2 segments, Unit Petroleum owns and operates oil and natural gas assets in the continental U.S. The key properties are located in Texas and Oklahoma, with other assets across a number of other states. The company owns almost 1,500 producing wells across 270,000 acres of land. And just from a production standpoint, over the last 12 months, Unit's generated over 1.5 million barrels of oil, 2.5 million barrels of natural gas liquids, and 27.4 million MCF of natural gas, equivalent to 8.6 million barrels of oil equivalent, or BOE, and it produces around 23,000 BOE per day. Total reserves, 67.3 million barrels of oil equivalent, and it's broken up approximately 13% oil, 32% natural gas liquids, and 55% natural gas. The company's revenue over the last 12 months, revenues of $305 million, operating costs of just under $100 million, and we'll talk about it more, but hedging cash flows have been a negative drain of around $89 million. So we utilize the MPC adjusted EBITDA of approximately $120 million over the last 12 months, with approximately $20 million of CapEx for $100 million of free cash flow from this segment alone. This slide highlights a lot of the high-level numbers I provided earlier, but Unit realized an average price of about $40 per barrel of oil equivalent, with operating costs of just over $11 BOE equivalent. So we think it's very profitable in a number of commodity price environments, with approximately $100 million of free cash flow generated over the last 12 months. And Unit has a legacy hedging program. The vast majority of the hedging program was enacted as the company emerged from bankruptcy, and that was in accordance with agreements with lenders. More recently, in Q2 2022, Unit layered on additional hedges at what we think are attractive prices, with oil in the range of $75 to $80, and natural gas, they put on some hedges above $9 an MCF. But to summarize, through the second half of 2022, Unit is essentially 100% hedged in both oil and natural gas, with oil around $55 and natural gas right around $4.75. In 2023, the company has 58% of their oil hedged, or we approximate 58% of production hedged just below $50 a barrel, and just over 50% of their natural gas hedged at just over $3. And so they are underwater on a lot of their hedges, but despite that, with their low cost of production, they're very profitable at their hedge prices, which minimizes the risk of what happens to the economics if commodity prices fall, while still retaining upside They're unhedged in their natural gas liquids portfolio and also have potential upside should prices remain where they are in 2023 with nothing hedged in 2024. And then in terms of our forecast for 2022, we think we'll see improved results, revenues north of 330 million, adjusted EBITDA of around 135 million, and forecasted free cash flow of 115 million. We forecast a decline rate for the company's assets of 16%. And in terms of commodity price environments, we approximate the strip pricing with a little discount, forecasting oil prices to fall to $65 by 2024 and natural gas prices to fall to $4 by 2024. Listeners might have different views on what the commodity prices hold in the future, but to give you an idea of what assumptions we use in formulating our fair value analysis. The next segment is unit drilling. Unit drilling operates 21 onshore drilling rigs across the United States. The key assets in the company's fleet are 14 proprietary Boss drilling rigs. They're known in the industry as super spec drilling rigs. They're new additions to the fleet, with the last 3 of the 14 delivered in 2019. These rigs cost over $20 million to build at the time, and industry participants estimate that today building a new super spec rig would cost in excess of $30 million. Unit's currently operating 17 rigs, including all 14 of their Boss rigs and 3 of their SCR rigs. Those are lower spec rigs that are legacy assets of the company. And the utilization of the company's fleet has expanded from operating around 10 rigs in 2020 to 17 today. Over the last 12 months, unit drilling generated over $100 million in revenue and $18 million in EBITDA. And the approximate numbers behind that, the rigs in the most recent quarter generated $21,300 per day in revenue. And that was offset by $17,300 per day in costs. So the segment's been EBITDA positive throughout the downturn. And I want to note and highlight that the market for super spec rigs has gotten very tight over the last few months. So as the rig count remains far below historical levels, but has been advancing, and especially for super spec rigs, which are in very high demand. Recent day rates for super spec drilling rigs exceed $30,000 per day and have approached $35,000 per day. The average contract length for unit's fleet is approximately 6 months. And we think the $21,300 per day rate that was seen in Q2 begins to approach $30,000 per day or higher as we get to year-end 2022 and beyond. And to provide an illustration of what this means for economics, at $30,000 per day, which is likely below where spot prices are, unit drilling generates $200 million in revenue and approximately $100 million of EBITDA. And we think a lot of this flows to free cash flow, and estimate CapEx for the segment between $10 and $20 million. So it's a much more recent phenomenon, but our outlook for unit drilling has improved dramatically. And looking at the revenues, EBITDA and cash flow that the segment can generate, we again think that this segment could be valued at the current enterprise value for the company if current environment remains in place. And next, I'm going to talk about midstream. Well, it's formerly the midstream segment, which is unit's 50% ownership in Superior Pipeline. This segment again was fully consolidated until Q1 2022, at which time unit deconsolidated the segment, and it currently has practically no value shown on either the balance sheet or income statement. Unit formed Superior Pipe. The Superior Pipeline was formed in 1996. In April of 2018, Unit sold 50% of Superior to two private equity groups for $300 million, which valued the segment at a total of $600 million. And so that provides an indication of what value was in April of 2018. Unit continues to own 50%. And the asset base has almost 4,000 miles of natural gas pipelines, a number of natural gas treatment plants, as well as processing plants, gathering systems, and compression systems, with assets based in both Oklahoma, Texas, Kansas, as well as the Marcellus Shale in Pennsylvania. And it's important to note that while Unit has a 50% equity interest, the terms of the partnership likely mean that Unit's actual economic interest will be less than 50%. And this was the reason for the deconsolidation. Based on their agreement, distributions from Superior are split 50-50 between the partners through 2021. And the split after 2021 is predicated on Unit having spent $150 million to drill oil and gas wells in geographies where Superior Pipeline operates. Their Unit did not fulfill that obligation, and due to that, 58% of that spending shortfall, or at the time $72+ million, would be distributed to the partners before distributions are again split 50-50 with Unit. So thus far in 2022, the partners have received 100% of the distributions, and that's reduced the current shortfall to $48 million. And we expect the partners to receive approximately $10 to $12 million per quarter. I expect this shortfall to be eliminated by Q1 or Q2. And in addition to the split of the partnership interests or the distribution payments, Unit's partners also have the right to force the sale of Superior in April 2023 and have a 7% preferred return on their $300 million investment. And of note, this preferred return is reduced by any distribution payments. So the current preferred return based on a 7% IRR is $353 million. And we estimate if distributions are received by the partners as expected, that will be reduced to $330 million by April 2023. So in the event that the partners choose to liquidate, they would receive the first approximately $330 million in proceeds, with Unit receiving the residual. So we think of this ownership as a slightly in the money call option, which could be very valuable if the partners choose to sell or choose to enact the sale of the company, and then valuation, Unit's proceeds or Unit's valuation will be based on the actual price received by the partnership through a sale process. So the bottom table there provides a graphical illustration of the distribution split, various scenarios. And as we think about valuation of Superior Pipeline, the company has historically been very profitable. In 2021, it generated almost $340 million of revenue, adjusted EBITDA over $50 million, and free cash flow of $28 million. Superior also has an unlevered balance sheet, basically with very close to zero net debt, and has since 2021 has generated a lot of cash flow and returned $57 million to its partners, with Unit receiving half of those in 2021 and all those going to its partner. And so we think units value here could, it varies significantly. I think we're conservative and place a valuation of $50 million on unit stake. Here's in the market trade between 8 and 10 times EBITDA. If you put an 8 times multiple on 50 million of EBITDA, you get a valuation worth of $400 million, which would provide in the range of $75 million to shareholders. But we note there remains a large amount of uncertainty regarding the potential economics to unit. And slide 19 summarizes our financial projections and valuation for Unit Corporation. We aggregate our forecast for Unit Petroleum and Unit Drilling, along with approximately 24 million in annual SG&A expenses to project consolidated financials. And again, for valuation purposes, we remove any historical results or future results for Superior Pipeline and value then at $50 million. So yeah, in summary, Unit Petroleum, we have generated 334 million in revenue and 134 million in adjusted EBITDA in 2022. Unit Drilling, 146 million in revenue and 41 million in adjusted EBITDA with corporate expenses of $24 million. And we utilize a 12.5% discount rate to obtain a target enterprise value of 677 million. And we add to then 116 million in net cash, 44 million in cash from proceeds from an asset sale, 50 million in value for Superior Pipeline, or target equity value of almost $900 million, or approximately $90 per share. And this represents a 51% upside to the current share price. And slide 20 provides just an overview of our projections and where we see the company going and the financial results in 2022 and beyond. And
Okay.
Also like
Michael, we got to wrap it up. Going a little bit over.
Sorry for going over, Ian, but
No worries.
To help with any questions.
If anybody has any questions on Michael's presentation, feel free to contact him directly on Microcap Club. And thanks for participating, Michael. Appreciate it.
Yeah, thanks for having me. Thanks, Ian.
Thank you. Yaron, are you ready to go?
Yes, I am. Let me just see if I could unmute myself. Can you guys hear me?
I can hear you.
Okay, sweet. I cannot start my video because my host has stopped it.
There we go.
Okay, start my video. And let's see if I can figure out how to share my screen. You guys see that?
Looks good. Perfect.
All right. And I see myself here as well. Hi, everyone. How's it going? Good morning, and thanks for everyone for taking the time to listen to us today. My name is Yaron Neymark. I am the founder and portfolio manager of One Main Capital, and I just want to take a second to thank Ian and Mike and everyone for organizing this week's event. All your guys' contributions allow us. We have a very vibrant and thriving community here for microcap nerds, and I think it's great that we have this. So thank you. So again, my name is Yaron. I'm the founder and PM of One Main Capital. And for those of you who don't know much about me or my background, I've been, a student of the craft, I would call it, for pretty much my entire life. At first, it was a hobby when I was younger. And for the last decade plus, I've been playing the game professionally. On the hobby front, it really started when I was really, really young. My parents are immigrants. They came here without a college education. They had a small little business. They had friends who were also immigrants without college educations who, came here and started businesses that ended up being much larger. And, some of them made life-changing amounts of wealth through business at relatively young ages. So I was just kind of enamored by that. And then my passion for it really grew when I started working for money. You know, in middle school, I was a babysitter. In high school, I was a lifeguard, and I worked at the local Guess Jeans, you know, folding clothes at the retail store. And in college, I was a server at the Olive Garden, and I made sandwiches at a local bagel shop called Einstein Bagels. And I saw how hard it was to work for $7 an hour, and saw what my parents' friends were able to achieve, and figured investing in business was the way to go. So at some point along the way, I started reading, you know, the Warren Buffett letters and the Klarman letters, like probably everyone here has done, and decided to pursue a career in investing. You know, I started out, you know, in private equity on the investing side for a few years, and then, you know, worked a bunch more years at hedge funds. And then in 2018, you know, the fund I was working for was shutting down, and I decided that instead of going and taking another job, you know, I'd go launch something on my own. So, you know, I've been running One Main Capital for just about 5 years now. And yeah, the strategy is, you know, it's pretty basic and simple. It's concentrated, long biased public equities. I have a value and a quality bent to my strategy. And the goal is really just to put up, you know, best in class performance for a very long period of time without going too far out on the risk curve. You know, by utilizing kind of the strategy that I've honed for my entire life since childhood. I was just studying businesses, and I think I'm a pretty good business analyst. I think I'm good at evaluating management teams, and have a pretty good feel, I think, for portfolio construction and risk management. And so, yeah, that's kind of the, you know, the overview of the firm and the strategy. You know, in terms of the way I achieve those best in class returns without going too far out on the risk curve, is by putting a vast majority of the fund's capital into what I call these core positions. And, you know, these core positions are, you know, I define them as high quality, predictable, well-run, well-capitalized businesses that are cheap on earnings or free cash flow 3 to 5 years out. And typically, you know, we have 10 or 15 of these types of positions that make up, you know, maybe 90% of the fund's capital. And then I also supplement these positions with higher octane, you know, what I call opportunistic positions, which I tend to size smaller because they're just riskier and lower quality type businesses, but they have a really big upside convexity. And typically, you know, I could have anywhere from 0 to a handful of these in the portfolio, and, you know, maybe they make up 0 to 10% of the fund. I would say I've made good money on both core and opportunistic since inception over the last 5 years. You know, on the core side, I've owned Rick, RCI Hospitality since inception. You know, I've bought a lot of shares at $15. It's at 70 today. You know, I've owned KKR for 3.5, 4 years now. That's gone from 20, you know, where I was buying it, into the 50s. And on the opportunistic side, you know, I've had a few investments where I made 5 or 10 times the fund's capital. And, you know, even though they've been sized smaller, they've contributed meaningfully to performance over time. So made money in both categories. Batting average is not perfect. I've definitely lost money in both types of investments. And I'm definitely not wed to any of my positions. As some of you know, if the facts change, you know, or my conviction changes, I don't hesitate to blow out of my position. So please keep that in mind as you guys kind of listen to the idea I present today. Do your own due diligence. Understand that I'm not always right. We could lose money, and yeah, if the facts change, so will my position sizing. But today I'm going to present an opportunistic investment, one of the higher octane ones that I think could be up 5 to 10x over the next 1 to 2 years. And obviously, like any good, you know, 5 or 10 bagger, we're going to benefit from significant earnings growth and free cash flow growth. But also, like any good 5 to 10 bagger, anyone who pitches it to you is probably smoking something or pitching something that has a lot of downside risk. So please keep that in mind as you guys do your research or decide whether you're going to buy any of this name or not. In terms of the business, this company, it sells wheels into the automotive sector. It's a leader in its core markets. Its unit volumes and profitability, well, its profitability is tied to unit volumes. And unit volumes are tied to passenger and light truck volumes, production volumes in both the US and Europe, where it's the #1 or #2 player in its various markets. And, as many of you guys know, unit volumes for the auto sector are just very depressed coming out of COVID. There have been supply chain issues in particular. Most recently, there's a chip shortage. And so, this is a slide that kind of shows you what light vehicle production looks like in the US and Europe for the last few years. In 2018, 2019, and even going back, if you go back 5 years before that, we were averaging probably 35 million cars on the light vehicle side between the US and Europe per year. In COVID, it fell to 27, and we haven't really recovered from that level because of the chip shortage I highlighted a minute ago. And, this is a chart of US domestic auto inventories. I'm sure, some of you guys have probably noticed that there aren't a lot of cars in dealerships. And I'm sure everyone's seen headlines on what's been happening with used car prices. They've come in a little bit this year, but they're still 50% above where they were in 2019. And what all this tells you is that there's significant pent up demand for new cars. And that when the chip shortage is finally done playing its course, which I think will happen in the next 1 to 2 years, I think we're going to see significant improvement in volumes and obviously profitability as well for this company. This slide, continued shift to premium wheels. So on top of the growth in industry production that I expect to come over the next 1 to 2 years, there's also an ongoing shift towards wheels that have more premium content in them. And this allows this company to grow its pricing per wheel. So as you can see on this slide, lightweight technologies are expected to grow at a 14% annual clip through 2025. Premium finishes at 11% over the same period, EVs in the 30s. And of course, I'm sure all you guys have noticed that more and more cars are coming with bigger and nicer wheels, 19-inch and larger are the premium sizes. And those are growing at a high single-digit CAGR. So all these technologies are kind of taking share of the wheel market, which are driving revenue and margins higher on a per wheel basis for this company. So yeah, an important part of the thesis here is that we're going to benefit from earnings growth, but we're also going to get a much better balance sheet in the coming years, which the company needs in order to address its capital structure. It's going to end this year with around $450 million of net debt against $175 million of EBITDA, so a bit over 2.5 times levered. And their term loan matures in May of 2024, and they have some bonds that mature in the summer of 2025. So by this time next year, the term loan is going to be considered current, and if we don't refinance it by this time next year, we're going to have a going concern in our audit, which no investors like to see. But I do think by this time next year, net debt will also decline from 2.5 times leverage to 2 times leverage just through EBITDA growth and some cash flow generation. And so on its own, that sounds totally manageable. 2 times leverage, I think any business could handle that. So it doesn't sound too bad, right? But we have a problem. That's not the only thing that investors are worried about is the debt. The company also has a convertible preferred instrument that it issued to TPG to fund a European acquisition back in 2017. And it's a mandatory redeemable convertible preferred security, which sounds scary, mandatory redeemable. Oh my God, TPG can force us to redeem this. And it's even worse because while it shows up on the balance sheet as 200, it's actually going to be redeemed for 300 million by 2025, which would add another 1.5 turns of leverage needed to take out the caps to complete the recapitalization of the balance sheet. So, that sounds scary, right? A cyclical auto supplier needs to take on 4 times leverage in this environment to recapitalize the balance sheet between now and 2024, right? Might not be for you. Well, this mandatory redeemable convertible preferred instrument, it's an equity instrument. That's important to kind of understand because the company's inability to repay this cannot put them into bankruptcy. I'll repeat that. The company's inability to repay this instrument to TPG cannot put them into bankruptcy. So the company could have just basically strand TPG as long as they can keep paying the dividend on this instrument, which is very manageable, then they could take their sweet time to repay it. So really all we need to think about here is 2 to 2.5 times of net debt to EBITDA can recap the entire thing, and the convertible preferred can be stranded and be paid back over time. The companies, I've asked the company numerous times about this. They've confirmed it. They've even added a disclosure into their 10K this year that confirms that. And there's really no risk that this could tip them into insolvency. And in fact, if the recovery takes hold the way I think it should, then in terms of auto volumes in production, they should be able to recap the entire thing, including the TPG instrument, in one fell swoop in the next 12 or 18 months. But even without that, the equity is not really at risk here. So yeah, here are my financial projections. I think within 2 years, the company will grow EBITDA significantly. Unit volumes are going to recover both in North America and in Europe. And then you have the mix of higher premium wheels that come with a higher price point and higher margins will allow the company to grow both revenue and profitability to levels that are meaningfully higher than the pre-pandemic levels. Incremental margins and decremental margins have usually been around 35% here, I think, and that's on an EBITDA basis. I think incremental EBITDA margins on a big volume recovery will be much higher than that, but you don't need to believe that in order to think that this is going to do really well, this stock. And so once you do have the recovery, I think profitability is up a lot. The balance sheet looks much cleaner, and there's a lot less hair on this name, so it becomes more ownable. In terms of valuation, here's some potential math around this company. By 2024, I think EBITDA grows to around 250 million. I think net debt is paid down by around 150 million compared to the current net debt balance of 770. I think it'll be down to 620. For reference, the market cap of this company is just around 100 million today. So I think they're going to pay down 150 million of net debt on a $100 million market cap today. And all that math shows you that, if I'm right, the equity can appreciate from just below $4 today into the 30s. And I think that gives you a 5 to 10 bagger here. So I know you're all eagerly waiting for the name of this company. It's Superior Industries. The ticker is SUP. Again, Superior Industries, SUP. So some catalysts and risks. Obviously, the key catalysts are recovery in production volumes, improved profitability, which drives EBITDA higher and also drives leverage lower. So the combination of those two things, improved profitability and lower leverage, I think will be a huge positive. I think, as the market cap grows, this becomes eligible for index inclusion again. So all the typical things you see when you want to look for 5 to 10 baggers, more institutional buying, more profitable, more cash flow, less leverage. And of course, I think a big catalyst is me talking about it today. Just kidding. I don't actually think that. And then in terms of risks, obviously I stated it earlier, but this is a levered business. I think there's a lot of downside. If I'm wrong, this could be a 0. And if the facts change, I will be out of this, but I think I'm right. And I think we're going to make 5 to 10 times our money on it. So I'm fairly excited. And so if you have any questions, happy to take them now. If not, you can contact me at yaron@onemaincapital.com. And thanks for taking the time to listen today, everyone.
Thanks, Yaron. We appreciate the time. The next presenter is Jeff Cole. Are you there, Jeff?
You see anything here?
There we go. There's your presentation. Now just put the slideshow. There you go. Perfect.
Not there yet.
No, do the other way. There you go.
We good?
We are good. You can go when you're ready.
Hi, everyone. I must admit that I was really surprised and flattered when Ian asked me if I would present at this summit. Just take a quick glance at the impressive list of accomplished presenters. Then there's me, someone who doesn't have any social media presence or run any outside money. It didn't take me too long to figure out why I'm presenting to you. It's the number of mistakes I've made in 35 plus years of investing and trading capital. Perhaps being older does have some benefits. Given my nearly invisible public profile, here's a bit about me. In the Microcaps Club,
I think we lost your audio, Jeff.
we good?
Okay, now I can hear you again.
Sorry, guys, you can see I'm a rookie at this. My real name is Jeff and I'm Canadian. I live in Toronto, and yes, I do like hockey. My country of origin is self-evident to those of you following my posts, since they are predominantly on Canadian listed companies. I'm definitely guilty of home bias. Since 2013, I have been a full-time private investor. Prior to this, I worked on Bay Street, which is the Canadian equivalent of Wall Street. For just over 20 years, I was a derivatives broker at a couple of Canadian banks and a small hedge fund. A bit more about my past in order to understand the lens through which I view markets. When I started in the business, I wasn't provided with a Rolodex of customers. I needed to go out and find them. Over the years, I built out a wide-ranging book that transacted in dozens of financial and physical commodity markets. My team's client base was even
We lost you again, Jeff.
Ian.
There, now I can hear you again.
Sorry, guys. Okay, so I had two types of client hedgers and speculators, using the same tools for different objectives. Given the diversity in my book of business, I gleaned invaluable insight into the minds of people that were the decision makers, both the good and of course the bad. I had a front row seat and I got paid to learn. Most microcap investors are bottoms up with their approach. They look at the balance sheet, management's history, insider ownership, and dozens of other variables. I look at these too, but most ignore the macro. Handicapping what the Fed's next move is, forecasting currency moves, or calculating the geopolitical landscape is downright tough and usually foolish. So the best thing to do is to stay the course on whatever your strategy is and stay invested. There aren't too many George Soroses, Julian Robertsons, or Paul Tudor Jones out there. But when it comes to macro, is it all plain vanilla? I believe there are other types of macro trends. Like, what about the E in ESG? Or what about moving from an analog to a digital world? These types of trends, to me, look more like this. I'd venture to guess that none of you would say that investing is easy. And most of the time, I find it a mix of this and this. The best way to describe my process is a barbell, one side representing the macro look, while the other the bottoms up. Before moving on to portfolio construction and my new favorite idea, I want to mention a long-standing, widely held perspective that fits nicely into the macro part of the barbell, and that is narrative. Many refer to the microcap universe as full of story stocks, and it's true. Some of you may recognize who this is. Many of you have likely heard of him. His name is Daniel Kahneman. He's a highly accomplished psychologist and considered one of the foremost experts in the field of behavioral economics, more specifically, judgment and decision-making. No one ever made a decision because of a number. They need a story. Stories are part of the investing landscape. For centuries, we've told them. As an investor, a huge part of our process is to filter through these, not avoid them. Tiny companies don't become big ones without identifying a long tail opportunity which some refer to as the story. Constructing my portfolio. Unless I see a 3-year plus runway, I'm just not interested. We have all heard about how investors hold equities for shorter and shorter periods. There are plenty of reasons why this is true. I'm convinced one of them is simple. Attention spans have shrunk as technology has advanced. It's so easy and quick to get reams of info. If the majority of people have shrunk their horizons, shouldn't a thoughtful investor extend theirs where it's less crowded? Finding new ideas that might be your next multi-bagger is hard. I don't find that many new ideas each year. My ideal holding period needs to be correlated to the velocity of my idea generation. I hold less than 10 stocks in my top tier. There are plenty of studies on what is the number of ideal equities to own. For me, the number of positions I own is a function of my practical bandwidth. I don't identify a company, buy it, and forget about it. The ongoing maintenance of staying on top of my portfolio is time-consuming. Once I identify a company that looks promising, I buy some stock, typically 1/10 or less of my max size. Then I take my pulse. How do I feel afterwards? Does my initial purchase motivate me to dig deeper? If not, why? Within a few weeks, if I'm not fully engaged with the research process, I just get out. I know myself well enough to appreciate that unless I'm excited by a new name to put in the work, something's wrong. If I become more confident that my research is on trend, I buy more. Management, of course, plays a big part in how big my position will ultimately become. If they aren't delivering, I won't add more capital. Over time, some will graduate into my top tier, but many won't. Buying is easy. Selling is really hard. It's so true. I continue to struggle with this. Overall, my philosophy has been that if your original thesis is intact and management is making progress, then just wait. Recognizing mistakes is really tough too. Dealing with them is even more difficult. My years of trading highly leveraged derivatives and the thousands of losses I've experienced has taught me not to get paralyzed when the facts change. But what about winners? What should you do? Does it make sense to take some money off the table as the stock hopefully runs higher? We've all seen how micros can stay dormant for long periods of time and then violently re-rate. I've cherry-picked 3 examples of companies I've written multiple posts on and what I've done and why. The first is VLE. I held the stock for a few years and then literally wham, it 10-bagged in short order. My original thesis was that enough natural gas was in place to ultimately support $50 a share. So by that, I should have held, but I didn't, at least not all of it. I sold about 20%. With the benefit of hindsight, it's a good thing I did. But the real reason I lightened up was my original position was really too large. Once at 10x, the daily fluctuations became too meaningful to my net worth and painful to stomach. So I reduced. Selling into the spike was the only reason I ended up earning about 2.5 times what I invested. I sold the remaining 80% well after the peak. The second example is UGE. I spent many months accumulating a position in late 19 and early 2020. My timing was uncharacteristically nearly perfect as the stock ran up 6-fold by the summer. I did nothing. That didn't feel too smart since it retraced over 60% since. My original view was that it would be a $10 plus stock, and it still is. The last example is NPK. After years of following this company, I felt like management was starting to deliver on their vision, and I started to accumulate. Over the span of 1 quarter, the stock re-rated by nearly 10 times. I sold 20%. I really struggled with this since my thesis was still playing out. Ultimately, I think this will be a multi-billion-dollar company, which equates to well over $40 a share. So why did I sell some? I'm pretty sure it's because of my experience with VLE, not taking too big of a position from the start, but the pain in seeing it round trip. I hope my experience here is somewhat painful as well, but only because one day I regret selling some too early. So there you have it. Even after decades in markets, I still struggle to be a better seller. Okay, let's move on to my idea. Devron, the company's mission statement is, we help local agriculture achieve excellence by making impartial data accessible and useful. I think their website landing page is just awesome. Devron touches more soil than anybody else. Your data is in the cloud, our people are on the ground. Devron started out in 2011 as an agricultural drone company. And since then, the company has evolved into acquiring local farm advisors, otherwise known as agronomists. They've also been buying soil laboratories. Nearly 20% of North America's landmass, or 500 million acres, are farmland. On only 30% of these acres are farmers collecting and using data to help them make informed decisions on a variety of inputs, like seed, chemical, fertilizer, and water. It's no surprise that utilizing data leads to improved outcomes through higher yields, climate impact, and of course, profitability. More people are starting to appreciate the importance of soil health. Devron offers broad-based, vertically integrated exposure to tapping into this via 4 key service offerings, including data collection, lab analysis, crop advisory, and an emerging carbon platform. There are 4 reasons why I'm excited about farm: unbiased advice, a fragmented market, last mile logistics, and carbon upside. So let's unpack these. The world of agriculture is understandably a massive market, some estimates reaching $1 trillion in the US alone. The industry is dominated by companies like Cargill, Bayer, John Deere, Nutrien, and DuPont. Traditionally, agriculture has been a slow, methodical industry that's resistant to change. And that's understandable. Imagine running a business and being subjected to uncontrollable factors like the weather. No wonder farmers are ultra conservative. Their average age is 57. The next generation are more tech savvy and open to change. Given the availability of cheap sensors, robust communication networks, and a better understanding in the power of smart data, these farmers and their suppliers are starting to embrace using technology. Of course, one thing that all these large ag companies have in common is their desire to cross-sell more products and services. There is a saying that the last person you want to ask if you need a haircut is a barber. Do you think Bayer can be trusted if they say to use more chemicals or seeds? Will Nutrien tell you to cut fertilizer use? Devron has no affiliation with any seed, chemical, fertilizer, or farming equipment companies. Farmers are a tough crowd to gain respect and trust from. Devron is in a fantastic position to fill this void through their agronomist network, a true and trusted local source of advice. There are an estimated 15,000 crop consultants and 140 independent soil labs in the US. Their combined value is about $5 billion. Most of these are run as mom and pops. Devron is actively buying agronomy operations and rolling them into and under their brand. At 120 agronomists and counting, they already have one of the most extensive and connected networks in the US. One very powerful reason why these agronomists are attracted to being part of the Devron network is the ability to free up time and earn more while maintaining an active role within their community. The company estimates that up to 30% of an agronomist's time is spent doing menial back office tasks that get streamlined once they join in. Devron doesn't have too much competition in consolidating these agronomists, which is surprising given the low multiples they're paying to acquire. So far, the range has been in the 2.5 to 5.5 times EBITDA. And typically they pay 60% in equity and 40% in stock over a 3-year period. The company is starting to call this the first mile. This is the toughest part that no one wants to do, but it can't be avoided. Deere has an attachment on its tractor that scoops some soil, but they don't have a local who takes a 12-inch core sample. There are numerous satellite and drone companies that take various measurements, but none of them can match the quality of high-fidelity data by having actual boots on the ground. As the world continues to evolve towards a more complete, trackable, and transparent food chain, the verification of this last mile is time-consuming and not sexy, yet necessary. The real money that was made during the California gold rush of 1848 was the suppliers of the stuff prospectors required. Things like axes, picks, shovels, and tents. I view Devron in this light. Soil is the largest carbon sink on the planet. The farming practices deployed do make a ton of difference. I'm not aware of any other company that is measuring, tracking, and warehousing this data under one chain of command. Yes, it's very early days, But Devron's off to a fantastic start and is super well positioned to be the leader in this exciting area. Although only launched in Q3 last year, Devron's carbon service already has $7 million in contracted revenue with 6 customers, which include the USDA, Corteva, Bayer, and Danone. While the numbers seem small given the size of these organizations, these are just pilot programs. One of the critical pain points that these tier 1 organizations face in scaling their budding carbon programs is cost-effective soil sampling and analysis, a critical process in this high-quality carbon credit origination. So why is now the right time for Devron to enter the big leagues? A few months ago, they acquired 2/3 of Canada's largest soil and tissue laboratory, A&L Labs, for $50 million. The lab processed 435,000 samples last year on behalf of 20,000 farmers. A&L generated about $27 million in revenue and just under $12 million in EBITDA. So on a multiple basis, Devron paid 6.3 times EBITDA and 2.7 times revenue. Devron had been working with A&L since 2019 and developed a relationship with the main shareholder and founder who started the business 35 years ago. A shotgun clause was triggered by the 2 minority partners, which opened the door for the deal. A good portion of the $42 million in cash was used to buy out the minority partners, while the founder took $7.5 million in Devron shares. He is remaining on the team as the operating president of the lab. There are enormous synergies in buying control of A&L. Last year, Farm collected 500,000 soil samples that were not sent to their own lab network. A&L operated at 75% capacity last year. Just filling this unused capacity alone should add over $1 million to the bottom line. The acquisition also comes with 30 years of data on thousands of fields. This database of soil and tissue samples should be very useful for their carbon service. At scale, which I believe this acquisition brings them, some very attractive margins should kick in. A few weeks ago, Devron reported their Q2 numbers. Revenue was $5.2 million. A key theme for the company remains how they integrate, realize synergies, and cross-sell these recent acquisitions. While it's too early to see any tangible impact on the organic growth side from their A&L purchase, it's not on the rest of their deals. Organic growth was a very impressive 65% higher, much bigger than the 30% the CEO had been guiding. The company expects to achieve EBITDA positive in the second half of this year. By the back end of next year, they should be on track for $50 million revenue run rate and $13 million in EBITDA. So that's Devron. And in closing, the 6.5 years since I joined the MCC universe have gone by really quickly. I have to admit that a big part of why I'm an active poster is due to me being selfish. It's easy to think something makes sense when it's in your head. Writing my thoughts down helps me think through my assumptions. And of course, feedback from our awesome community helped too. Hopefully some of what I said resonates with you and will help you make fewer mistakes along your investing journey than I have. Thanks for tuning in. I appreciate it.
Thanks, Jeff. We had one question that just came in, and the question was, is Devron promoting no-till soil practices?
Not directly, no.
Okay.
No, they do. It's well known no-till farming allows carbon sequestration to a much greater absorption rate. So I guess it's kind of a given. It's not part of their platform per se.
Okay. Is there a same question, or just ask, is there a carbon negative angle at all?
I don't understand.
Give him a couple seconds, see if he explains a little bit better. Sequestering carbon, so like an ESG angle probably too as well.
Yeah, for sure there is. It's a very nascent field right now, and some of these companies that have employed Devron are still trying to figure it out themselves. So I don't know how it's all going to flush out, but the whole point is you need somebody that has local knowledge and boots on the ground in order to to be able to collect the data and verify in order to generate these high quality carbon credits.
Mhm. Okay, well, that's all the questions we had. Thank you, Jeff. Appreciate it.
Thank you.
Our last presenter of the morning session is Maj. Maj, are you there?
Hi, and I'm here. Yep, just getting on over here.
There you are.
Thanks, man.
Yeah, thanks for being here. Yeah, the floor is yours.
Let me share my presentation, everybody. So give me a second. Let me see. Can you cool. Can you see it now?
Yes. Yeah, just turn on slideshow mode. It should be
Yeah.
perfect.
Yeah. Cool. Let me just go to the top here.
Yeah, that looks good.
All right, man. Thanks, everybody. Thanks again for being here. I'm glad to be part of this again. This is an awesome club, and it's always a great time to be part of this wonderful community and to collaborate ideas. For those of you who don't know me, my name is Maj Swedam. I'm co-founder of GeoInvesting. And just please be aware of my disclaimer here that nothing here is investment advice. I will own a position in the stock I am going to talk about today. Do your homework, and if by viewing this, you agree to my terms and conditions of GeoInvesting. So again, I've been a full-time investor for 30 years. And I co-founded GeoInvest in 2007 to kind of bring some of my experience I've got kind of culled over the years to two other people. It was a free service at first, and eventually went premium with it. And I really enjoyed my ride, and I kind of agree with a lot of what people said out here today in terms of collecting experiences to kind of really improve your strategy over time. And it's really what I've done over time. And I just love being a microcap investor. Love investing in small companies and understanding that there's awesome opportunity out there. And the crux of what we do here, I think we all do it, is just we love the microcap market because it gives us opportunity to kind of hunt in a place where it's not as competitive, maybe. And even if there are other great investors investing in a space, we all have different strategies the way we approach things. It always amazes me as I might hear an idea from somebody and vice versa, and we might not like them. But they might be great ideas. And that's what I love about this space, and I love about investing in general. There really is no right or wrong way to, I think, invest. If you kind of align with what you're doing and everything, have a process. So, a lot of, what I have when someone asks me what my strategy is, and I really think about it, it's everywhere, really. I'm looking for great opportunity in areas I can understand where I've just had a great experience over the past, and implementing them. There are some areas I avoid, and I'm going to get into that in a second, but in general, I'm just looking for great opportunities and lots of different stories. And that's why I think it makes microcap investing exciting. So, just real quick before I get into the strategies, a little bit about GeoInvesting. We have a really wonderful catalog now of 14 years of research, that a lot of organic research, most of it, that our members use to help, kind of spearhead their research. We're very active with our community, sending out emails in the morning, every morning, weekly updates, monthly updates. We have research reports. We got small little kind of, we call reasons for tracking kind of reports. We've been doing a lot more live interviews and fireside chats with management teams. We also do morning updates with teams when they have earnings, just to kind of give us an idea of what's going on, for like a little short clips here and there. We wrap it all up with a monthly forum where we talk about what happened in our universe. It's usually an hour or 2 hour kind of conversation as we go through all of our stocks in our universe. And we also have some handpicked contributors that bring us ideas on a pretty routine basis to the platform. So, it's funny, as I've evolved, I ran the website for a few years now, and if you ask me how to describe geo investing on day one versus this house now today, it's changed a little bit. And really now we're really, and this is most important now in this environment we're in now, we follow what we want to play in this tier one kind of universe, we call it tier one quality universe. And by the way, that doesn't mean we're looking for companies that are tier one quality. They have the potential to get there potentially too. And that's sometimes why I like hunting the most, actually. And ugly companies that are going to get to these kind of maybe meet these criteria eventually. So I'm looking for, and I'm just going to really list them real quick without getting too much into them. Those companies with a long operating history. I love these companies that have been around for a long time, 20, 30, 40, 50 years. Because they're real companies, a lot of them, they might not be run efficiently, but they have a great markets, that great presence, maybe great customers. It just takes a little bit of change to kind of maybe inflect that growth at some point. Of course, strong management, that goes unsaid. We look for management teams that are focused on the business, not so much a stock price. Of course, you want management teams to want the stock price to go up, but we don't like superficial kind of pump and dump kind of, overly bombastic press release. So we're looking for more of, hey, how you're looking to maximize shareholder value? You're going to buy back stock. You're returning, capital shareholders. These kind of exploring strategic alternatives. These kind of things. That's a better kind of, I think, way of looking at how I want a management team to look at the stock price. We're looking for companies that are generating revenue. We're not looking for development stage companies. We like them to be at or near profitability. In most cases, I mean, there are some situations where if they're a recurring revenue or SaaS company, we'll tolerate like a break even type of situation, as long as they can grow without having to raise too much money. When we do look at probability turnaround stories, this is one of my favorite areas to kind of play in. We're looking for high probability turnaround stories. And the idea I'm going to pitch today, I think, falls into that category really. Obviously, we like high interest ownership. We like a manageable debt burden, but again, we like companies that might have a big debt burden. There's going to be ways that they're going to reduce that debt burden over time, because a lot of people will ignore those stories. So we're trying to maybe fool the market there sometimes. And ability to grow without excessive dilution is really important to us, without having to raise money all the time. And shares outstanding are not excessive. I understand it's about value, right? It's not necessarily about the shares outstanding, but the outstanding share count kind of gives me a window into the soul of the management. Like if I can find companies that haven't diluted over time, that's really a really good sign. So when I look at those small shareholder outstanding share counts, it kind of gives me that kind of starting point. Those that have had a lot of outstanding shares, maybe it's showing that they have to keep issuing shares because their business plans keep failing along the way. Someone else is sharing their screen here, guys.
Sorry about that.
Okay. I think that might be it.
There you go. Go ahead. Can you pull back up, Maj?
Pull back. Okay. Let me get up here. Here we go. Cool. Probably a better picture than mine, by the way.
Sorry about that. Go ahead.
That's okay. So as we move on here, so an example of, so again, I want to stress again, I don't want people to think I'm looking for these incredibly clean companies. Of course, if you go find a clean company that's undervalued, and it's more of a chance of finding that in the nano cap space than the big cap space, that's great. But I love the dirty companies that turn, that can get cleaner. And BXC, I think, Blue Links is one of them. I pitched in the club, one of my first stocks I pitched. Did pretty well, and it was maybe around $10 or so, and everybody I talked to hated this company. This is a really old company, building supply company, lumber, almost bankrupt at one point, and they've been telling the story of a very structured story for many years, since 2009, when we came out of the global recession. And I interviewed management and just believed the story. And the whole one thing I keyed on was if they can pay down this debt, or if they can not only pay down the debt, but there was also a controlling shareholder that was owned a lot of the stock that was preventing them from kind of doing the things they wanted to do. He eventually got out of that company. So those two things combined worked, they catalyzed, and the shareholder sold a stock in an offering around $7 a share. And then immediately you saw some insiders buy some stock. a few months later, they made an acquisition. The stock went from, I think, like $12 to $45 in one day. You'll see the chart over here. And I sold it here and they came back down and went back up. But that shows how you can look really ugly and still succeed. Now, I have this is, in the housing, they depend on housing starts. So I'm not investing in the long term. I didn't. I got out of it really short. But this is a typical company I probably wouldn't have invested in had it not been for that opportunity. I don't invest in these very cyclical companies. But there was that really special situation that I thought warranted it. So I will look outside the box of my preference, buckets too. Often, if it's when you size your bets accordingly, and then I'm all about sizing bets. If I love a company, I'm pretty high conviction. I go in it pretty hard, pretty fast. But I have a longer tail where I have these little small companies I'm waiting on to percolate here and maybe do well. So into my strategy bucket. So the core, of course, I guess you could call me a GARP guy on the core. I love finding. I don't have to find stocks that are growing, 100% a year in revenue growth. I like these 10 to 15% growers in top line if I can find them with lots of margin expansion. I'll buy, I'll look at stocks that are pulling back. I'll look at momentum stocks, clean capital structure. That's kind of the core. If I can find these companies that are clean and in these buckets here that are undervalued, fine. It's not easy to find, but if I find them, I love it. But so I'm usually hunting in this area here, these kind of strategy buckets here with special situations where I'm looking for, event-driven catalysts, balance sheet restructuring, M&A situations, whether it may be particularly a target or we'll do some reasonable acquisitions to kind of catalyze the growth of their current, organic business. I love buying stocks that, fall on non-dilutive offerings. A lot of times you're getting a shareholder out of the company, like a BXC situation. I love business model restructuring. We saw a lot of the situations where you had companies going from in the software area from to more of a SaaS kind of model, which was a great kind of thing to exploit for many years. And then we look at stocks where there's maybe some interesting shareholder activists getting involved sometimes to maybe help turn a company around. And then finally, I love these long shots. I love investing in stocks that are, penny stocks under $1 that are, just misunderstood, and for some, there's a lot of tier one potential in these penny stocks. And I think that's where I think a lot of us had some of our biggest gains maybe because they're the most ignored and everyone thinks they're all, pieces of crap. But, I think, I don't define quality by the price of stock. I define it by the quality of business and the potential for the future. So that's where I place a lot of my bets there too. When I first started investing, I was really all about short term. I think I based everything on fundamentals. Even when I was a short term investor, I was looking for companies that would where there was going to be a really good growth momentum for maybe 4 to 6 quarters or so, and I would ride that and get out. And then over time, after 2008, that strategy wasn't working as well because there was not really a lot of demand for our smaller cap companies. You had to hold them longer term. So I had to really kind of shift my strategy a little bit and think longer term because I had to hold these stocks longer term. So I wanted to know the risk I was going to be, getting into. So I pivoted a little bit then and became a much longer term investor. So now I have a portfolio. My top 5 or 6 companies probably are really these stocks I want to hold for a long term. And around it, I have these short term kind of bets that's still on my old strategy. So it's kind of cool to have both things going on. I calculate this thing we call the Geo Power Ranking, which is we try and figure out if we can find a need of a growth of a cycle of a company. Can I get a 4 to 8, 4 to 6 kind of run in earnings? And if the stock is undervalued, I'm going to want to maybe buy that. So that's what the GPR is at 11. And I think it wasn't really working well. It worked really well for the first 20 years of my career. Then we went into the 2008 recession, came out of it, didn't work as well anymore. Now I see it working a lot. Now that we are in a new environment now where earnings matter again, you can't throw darts. It's not everything goes up. I think this is really going to work really well. I think investors have to care about earnings. That's a new mindset. So I'm really excited about this part of my strategy coming back so I can have a long-term and short-term type of piece to my strategy that's going to work, hopefully. And then, so again, I make a list of all these, I've been doing this for so long that I always make these, I make a list of multi-bagger trades I came across. I also make a list of red flag stuff too, which is not on the slide here today, but because that'll take too long, where I went wrong. But But I try to focus on the positive and find out, some of the areas I like that tend to be the most chance for multi-baggers. And it's increased wallet share, getting more revenue for your customers, strong operating leverage, growing earnings faster than sales, small niche markets that isn't going to attract a lot of attention. Early stages in the margin expansion cycle. I love that. Shift to recurring revenue models, improving capital structure. We talked about that. Examining market trends as it plays in the company's strengths. So, for example, what does that mean? It means like now we have a little protectionism going on in the world, right? Where everything's coming to the U.S. We're not companies want to outsource as much to outside the U.S. So there's a lot of companies that are going to benefit from that type of trend. So I'm looking for companies that have like large market share presence in the U.S., for example, that have a lot of competition from China maybe, and that competition is leaving. So that leaves a really nice playground for them to pick up, some more easy market share. Then of course acquisitions. Not only that, just add revenue and earnings, but I want these acquisitions to actually be synergistic with the company itself. I hate seeing these companies like will buy acquisitions, but then they don't do anything to the base business. I want to see those acquisitions not only growing, but also helping the legacy business grow also. And that kind of works with the wallet share situation there too. And a lot of times you'll see a company will be acquired, then that company can help get more revenue from current customers for the company. So those are some of my things I look for. So again, in closing remarks, I'm a concentrated investor, have a lot of stocks, small positions on the long tail. I do short-term and long-term investment horizons, and I avoid areas I don't understand or that I don't have a good deal of, or that don't have a good deal of, they have a deal good of predictability, such as mining. I don't understand banking too much, so I don't play in that too much. So I don't like to invest in commodity stocks, oil stocks. I missed that big boom, obviously, but that's basically it. So let's move into my pitch today, the SPAR Group, SGRP, and this is going to be not your typical microcap company. They have 50-70 million revenue. They've been around for 50 years, and we're going to get that in a second. But when I was looking at this company, I like to read conference call transcripts all day long, and I compare them with the press releases. And if because we focus a lot at Geo on information arbitrage, we're trying to find all this misinformation in different sources in the nanocap land and put it all together between SEC filings, press releases, and conference call transcripts. Really not that complicated if you put the time in to find the stuff. So I came across, this transcript of the company. I think it was maybe Q4 of last year, and the CEO who basically joined the company, I think in February of 21. If you gave me 100 chips to place in the business, I pushed them all in on SPAR. And then I came across this wonderful passage. Given the recent volatility in the markets, we believe investors will be searching for growth at a reasonable price. We believe that SPAR's investment thesis provides investors with a compelling investment thesis to consider. So this guy's touching on the things I want to invest in, and I like that he understands what kind of market we're in. And what he's saying there, I really believe in it. So now I'm trying to dive. This is a company I just kind of came across not too long ago, actually a month ago. And I'm still really early in the due diligence, but I don't have a great handle on like the growth prospects, 5 years from now. But I like the position of the company in their markets, and I'm going to get to in a second. And I like the CEO kind of approach to how he's thinking here, and you'll see that as we move on over here. So what does this company do? So these guys, I guess it's pretty boring. Merchandising and branding help the company. So either brand marketing or to retail locations. So you think of when you go to a CVS and you see someone stocking the shelves, that could be them. If you see a retail operation opening up a new location, they could be there in the grand opening, helping to get things right, the pricing right, branding, the displays, all these things. So it's boring, but it's needed, and it's really I think gonna be more and more of an in demand as we move forward, especially as if we enter in a recession or tougher economic times. You're going to see companies laying off people, probably maybe in this area, and why not outsource this to those that are experts in doing it, and use your employees to do better things that they're better experts at. And I think that's going to be a growing trend. as we move forward. So now, this why I'm excited about the company is this legacy business, and I'm going to get that in a second. I think there's a lot of opportunity just in the legacy business that this new CEO is going to try to exploit. But they are going into new areas, and that's I like that. I like that about the story too, because it has not only do I think it has some interesting stuff on the legacy business, there's stuff going in the future they're going to be doing that could be really nice little optionality to it. And they're looking new areas of focus of ways to get that analytics business going, where they're kind of helping these companies make decisions quicker, branding, pricing, inventory decisions quicker on the fly. Part of that is they have this cool little thing that's like a crowdsourcing thing where they're actually getting pictures in real time of a location and getting feedback right away to the customer, to the retailer. And they're doing that through crowdsourcing, through like shoppers and just other kind of AI things. And they also want to they're getting into fulfillment services. So they're just trying to, if they're already touching the customer, they're trying to figure out how can we do more things that we're already touching the customer. And fulfillment services is a natural extension of that. So we move on here. I'm hitting the stock price is $1.47, market cap of 32 million. You can see all the stuff over here in front of you. Shares outstanding only 22 million. Now, this gets the complex of the story here is they have some about 70% of their business is in the U.S. The rest is overseas, these JV partnerships. So it makes valuing it a little complicated. So I'm not really concentrating too much on the valuation right now. I mean, all that they do have, I think, you an EPS rate of 21 cents, PE of 7 on that, 4.7 time adjusted EBITDA. I just think it's a reasonable valuation, even though it's early in my process. And this is one of those long tail type of situations I'm looking at. I want to buy this and have my portfolio. And you're going to no debt. They have 12 million cash, and I'm just still calling through the story a little bit. But I think what I'm doing here, I think I'm buying the story at a reasonable price, with very little downside and lots of upside if things go right. Moving forward here, so as you can see here, now this carries one of my most favorite multi-bagger traits. It's wallet share gains. I think this company has an opportunity to get a lot of revenue from its current customer base. As you can see here, you got CVS, Dollar Tree, you got Target, Red Bull. I mean, the list goes on and on here of great customers. This is just a typical situation I see in a lot of these older companies that have these great kind of brands as customers, and just can find great ways to maybe get a huge revenue lift just from them. And in this case of a SPAR, they can gain more location accounts from a brand. So if they're doing a brand in one store or one geographic area, they can say, hey, well, why don't we do you in Michigan too or something? So they're concentrating more on that. So where they're having success with brands, they're trying to expand with that brand to other locations. The upsell services, they do a lot of merchandising kind of services, and they might not do them all to a particular customer. Cross-border international expansion. So the same thing as the gaining more location from accounts from brands. So they're having success, for example, in Brazil, where they have a JV with a particular brand. Why not try that? Why not go to the US with that brand and say, hey, you can do it over here too? And introducing new services is also a thing they can do here to their current customer base. And what's interesting, I had a little brief conversation with CEO yesterday, and he said, these are, when he came on board in 21, he was amazed that the organization wasn't really focused on this. So he's really made a really good attempt to really get the staff and the employees on board. Hey, customers are asking us for this stuff. It's for more, and why we haven't given them more revenue opportunity, more of these services. So you need to be more aggressive in being out there. It's out there to get. So he's having some early success with that right now too. So HHS, Hart Hanks, is an interesting blueprint. It's been a similar industry than SPAR and their CEO came in the company a few years ago, and the stock has gone from $3 to I think $14 today, based on just doing the same thing. They have a fulfillment service. They had a customer service area, and they had a digital marketing area, and they just basically went and just cross-sell the hell of those divisions, and then they to their current customers. and upsell services, and it was just a blueprint that worked really well. So I thought that was interesting. It's in the same industry to some degree in some areas, and basically I think SPAR is trying to play the game. Now let's go real. HICC doesn't meet my tier. It meets probably 8 of my 10 criteria. Been around 50 years. Strong management. I'm still fact checking. I didn't give this a yes yet. That's why I have 8 here. It's one of the ones that didn't meet. I'm still fact checking the CEO's claims of what he's done, but he seems to have a really great history, great in the retail space, and helping turn companies around, and building companies from scratch. So I'm pretty optimistic about putting that to a 9 soon. Management focus on the business, not artificial stock price movement. He came in already authorized a share buyback, already exploring strategic alternatives as of last week, put a press release out about doing that. They're generating real revenue. They've grown from 119 million revenue in 2015 to 256 million in 2021. They've been profitable for 4 years. Maybe not growing, but I think they're going to grow. But they've been profitable, steady profits, and that's why I like this. This is a situation. It's not, even though they meet a lot of these criteria here, there's some pieces of it that aren't sexy to investors yet. Sure, they're profitable, but not really growing a lot. They're just maintaining profitability. And I think that's a big key here. And I think once that starts to play out, that you'll start to see more investors come into this thing. Moving on over here, high probability turnaround story. That's definitely yes, because of this, what I talked about earlier, basing the wall share thing, is it makes for a great turnaround story. I don't even know how to call it turnaround, but definitely it would fit there. This is a really big no here. Higher inside ownership. So 50% of the company is owned by the co-founders of the company, who are not friendly, by the way. And only 1% is held by who I would call friendly. I should say friendly, by the way, friendly hands. And I wish there was some more insider buying by management. So that's something I'm taking up with management and finding out why the hell they're not doing anything there. Manageable debt burden. Yes, they have very little long-term debt. They get 12.1 million cash, current ratio 1.38, and then days receivable 83. This is pretty cool. The ability to grow without excessive equity raises. Shares outstanding have only gone up, a couple million since 2000, from 18.3 million to 21.9 today, and shares are under 50 million. So that meets that criteria there. So let's get this really quick here. So the CEO was appointed in February 21. And immediately he took action to basically, the co-founders of the company, the majority shareholders, were basically handcuffing the growth initiative of the company. And he inked an agreement with these guys to basically relinquish control of decision-making things for to help grow the company that the company wants to do. And he inked that, I think, in 21. So that basically is gone now. That was great to see that. I don't want to get into what these co-founders were doing. You should probably call it, if you're interested in the story, call the CEO and find out some of the things that were going on that now are not happening, which is going to be able to help this company grow and implement the strategies they need to implement here. There's obviously now they eliminated preferred stock. They put a better corporate governance in. So I talked about earlier about aligning employees with a new vision to drive sales, about getting wallet share. I talked about the 500 share purchase program, 100,000 share purchase program. And CEO, by the way, is very hands-on. I love it. He's all over the place. He's meeting customers. He's traveling. He's making sure that he is on the pulse here, trying to get this wallet share thing moving. They announced a strategic alternative. So I think that these guys could be, is the company for sale? Could they get bought? And interestingly, they've announced a strategic alternative, press release last week, I think it was. And I'm actually thinking Hart Hanks, HHS, could be an interesting candidate there. They definitely play in a similar industry. And I think that the momentum that HHS has now in their turnaround could really, really ignite what SPAR is doing. So I'm going to watch that very, very closely. It also could be a customer experience management company. Those are companies that help companies understand their customers more to help drive revenue. So that could be a potential there too. So another reason this might be ignored by investors right now too is that The revenue growth doesn't look that great right now. I mean, this year has been good in terms of profitability. But revenue's been flat. If you look under the hood, you'll see that pieces of the puzzle are coming together. So even though all of overall revenue was flat for the year, 6 months, the U.S. grew by 16%, which is 40% of revenue. The Brazil joint venture grew 25%. If you wasn't for some of the China business they have and the lockdowns going on there, revenues would have been up 10% actually for the 6 months. So as that plays out, hopefully it becomes more clear what's going on there. Hopefully investors will find it. I love finding these companies where the consolidated revenue isn't looking good, but under the hood you find some of these kind of success in some of the things that are going on in some of the other divisions and other areas.
Hey, Maj, you got 1 minute left?
Sure. Yep. So the caveats here, right? Could this be affected by a recession? Maybe yes and no. I mean, obviously, some of their clients are retail, but I would think also, as I mentioned earlier, I think there's reason to believe that if there is a recession, there might be more reason to think this company will do well, as companies lay off people and they're going to need to still have brand and merchandising efforts, and they're going to want to outsource that. Sales have been range bound the last 4 years, but I talked about that. 19% gross margins are not attractive at all, but I think they're actually closer to like 27%. When you factor in some one-time things that are going on right now. I don't love the JV structure. These large legacy shareholders seem to be selling the stock. They want out, which, by the way, could turn into a positive. Maybe that will catalyze a sale of the company. I wish management had more skin in the game. Haven't been cash flow positive for the first half of 2022, but they were cash flow positive in 20 and 21. I think the reason they're not positive this year is because of some of the impact on China on the bottom line. It's a labor-intensive business, so we got to worry about that in terms of wages and things. And I'm still trying to assess if there's what kind of operating leverage is involved with this company. If there's so that's it, Ian. But thanks a lot, guys. If you have any questions, just email me at maj@geoinvesting.com.
All right. Thanks, Maj. Appreciate it.
Thank you. Thank you.
Okay, Joe, are you ready?
I am. Can you hear me in?
I can.
Okay, great.
There you go.
Hey, everybody. Good to see you. Am I live or not yet?
You are live.
Okay. Good to see you.
Get started.
Yeah. Nice to meet everybody on the line. Let me screen share here. Okay, perfect. I have this bar is in the middle of the presentation. Let me move it up. Perfect. Well,
Looks good.
Thanks for tuning in. How many people are on the line, Ian?
We about 130.
Wow.
Yeah.
Okay, well, anyways, good afternoon. My name is Joe Boscovich Jr. And I am a partner with Los Angeles-based Old West Investment Management. My stock presentation today will be on a company called WildBrain. For those that are actively involved in Microcap Club, you may have seen some of my writings on the company, but it's a name that I'm extremely excited about. And I think it represents one of the best risk-averse opportunities that I've come across in my investing career. So what is WildBrain? WildBrain is a children's content and brands company. They are the last big independent player in the kids and family space as the largest independent owner of kids character brands outside of the major Hollywood studios. WildBrain makes money by producing children's content for a first income stream. They then distribute those cartoons across the various streaming video on demand platforms, linear broadcast channels, and on their own advertising video on demand network, WildBrain Spark. And then most importantly, for a third income stream, they license all the consumer products based on those brands. You can see on the first page of the presentation here, I've included a quote from Warren Buffett and Charlie Munger from 1996, talking about Disney's portfolio of IP. They say, quote, "It's nice to be able to recycle Snow White every 7 or 8 years. You hit a different crowd, kind of like having an oil field. You pump out the oil and then it all seeps back in over 7 or 8 years." I would like to asterisk this quote though by saying that there are very few global franchises like Snow White. And although various great character brands have been established over the years, investing in a company that is attempting to develop a new franchise is akin to speculation, not investing. In WildBrain's case, they already own a top global character brand, and they are focusing on other properties that have histories of being a great franchise that they are simply attempting to reactivate. But I'll get back to that a little later. So a little bit more about Old West though first. Not too different than other value investors, our investment philosophy has 3 core tenets: a focus on people, attention to fundamental business analysis, and at our core, we are value investors. So first and foremost, a focus on people forms the core of our investment process. As a first principle, we believe that the surest way to protect and grow our capital is by aligning ourselves with management teams who have high stock ownership and smart shareholder-friendly pay. Second, we focus on our fundamental business analysis. We are bottom-up investors and we try to deeply understand the businesses and industries that we are investing in. And third, we're value investors. We want to pay cheap to fair prices for good companies, but since cheap stocks typically stay cheap, we spend a lot of time trying to understand the soft or hard catalysts that will unlock that business value. So down below here at the bottom of the page, we uncover potential actionable ideas in a number of ways, but once we find an idea that is a candidate for our portfolio, the proxy statement is always our starting point. It is our contention that incentives matter deeply and that there is no surer way to understand the character and motivation of a management team than to study stock ownership and how management gets paid. In the time that it takes us to print out the proxy statement and study stock ownership, pay levels, and the business metrics that drive incentive pay, we're able to intelligently eliminate the vast majority of potential companies that would otherwise absorb much of our time and resources. So simply, we seek to invest with management teams that have more to gain or lose through their equity ownership than they do through their compensation. And this focus on shareholder-friendly management is critical and first most to our WildBrain thesis. WildBrain first came to our attention when Fine Capital, a fund manager that we regard as smart and intelligent, pitched the idea at the 2017 Sohn conference. We found the idea interesting and we were attracted to the core thesis of kids content being able to be recycled over and over again. But at the time we had concerns about company management. That changed in late 2019 when WildBrain appointed Eric Ellenbogen as its new CEO. I've met Eric a number of times. I talk to him several times per year. You can see here that he has a storied career in developing and selling kids content, and he's doing it again now at WildBrain. You could see that Eric, back in the late 90s, he was the president at Marvel before it was sold to Disney. He then founded a company called Classic Media, which became one of the largest private owners of branded kids and family content. They owned brands like Lassie, Rocky and Bullwinkle. In 2012, he sold Classic Media to DreamWorks Animation, and he became an executive at DreamWorks Animation and was there for several years before DreamWorks Animation was bought by NBC Universal, and then he became an executive at NBC Universal. So, clearly Eric has an amazing career and track record of success in the kids content industry. But one of the things that really caught my attention and was really when we made this a core position shortly after he became CEO was going through the first proxy circular. And you could see here, I boxed this just because I think it's amazing. And I've seen very few compensation packages like this, but Eric, half of his compensation was cash based, a third of which he is required to buy stock on the open market every year. And then the other half of his compensation is stock based, where he gets stock grants, half of which are given to him over a period of time. But the other half of his stock-based compensation vests at prices of $7, $9, and $11. And the current stock price today is right around $2.30. So I can't remember many times when I've ever seen management incentivized so heavily with stock that is so out of the money. And I think it is indicative of what Eric thinks the opportunity is here at WildBrain. This stock is thinly traded. There's not a lot of liquidity, but if you do your work and you understand what you're investing in, ultimately that is a blessing and enables you to make tons of money. And you could see right here that Find Capital has continued to increase their stake in the company. They own roughly 50% of the shares outstanding. The board and company management owns 10%, and we own 8%. So 68% of the stock is held and is not for sale. And I could tell you that I know several other shareholders that probably collectively own another 20%. So almost 90% of this of the float is not for sale, and eventually that will create I think just set up an amazing situation. So why WildBrain? WildBrain has developed a 360-degree approach to drive momentum across multiple earning streams. And the company is a very unique asset in the kids space in that they can be the captain of their own ship from start to finish if they feel it serves its best interest. And what I mean by that is that the company's a vertically integrated producer, distributor, and licensor of children's brands. And other than Disney, Universal with DreamWorks Animation, and Warner Brothers Discovery, which owns the old Hanna-Barbera library, I don't know that there is another company that can say this. From a content production standpoint, they are the copyright owner for most of their IP that they are turning into cartoons. All of the other small studios are either licensing other people's IP as service studios, or they are producing content for IP that they own, but that has little to no track record of success. From a content distribution standpoint, WildBrain is cutting deals on content with SVOD platforms when that deal is a great deal for them and for their shareholders. And if it's not, they can pump that content through its own AVOD network, WildBrain Spark, which reaches 1 in 3 kids globally, which is a larger audience than PBS Kids, Cartoon Network, and Nickelodeon. The company has successfully turned Spark into a profit center by deriving brand monetization through ad spend, but where it serves the greatest benefit is as a brand builder by building affinity and engagement for its IP. Whereas most content producers are beholden to the terms offered by a Netflix or other streaming service, even if those terms don't earn the money, if WildBrain isn't offered the right deal, they can go grow the brand through WildBrain Spark. The recent activation of Strawberry Shortcake franchise is a great example of this. After not finding the right new home for a brand new Strawberry Shortcake launch, Berry in the Big City, well, they launched it on YouTube. It's been a great success, and it's led to a recent deal with Netflix for several Netflix exclusive Strawberry Shortcake specials that will launch next year. And then finally, as licensing agent, WildBrain licenses all the consumer products for its IP. And for the select brands where they are not the copyright holder, they've only created content for partner IP where they've negotiated significant consumer products rights on brands that have huge histories of consumer product success. Under Eric Ellenbogen, the company has continued to layer on deals, each of which act like an annuity to the company. And if handled correctly, each property will continue to generate cash for years and years to come in the form of licensing deals from consumer products companies. I put a couple of the brands here at the top of the page that they own, and you'll notice that the properties that they choose to reactivate are only properties that have rich histories of consumer products. I've learned the hard way that movies and television is not a business that you want to invest in on its own. movies and TV shows are only good investments and that they serve as giant commercials to sell everything else. So really, WildBrain is a children's consumer products company. And this is demonstrated by the fact that almost half of the company revenue comes from consumer products licensing. So really fast, I want to get back to the quote that I started my presentation with from Buffett and Munger. As I mentioned, there aren't many global franchises. And if you don't have one, trying to develop one is like throwing a bunch of darts against the wall and hoping something sticks. If it sticks, you can make a fortune, but that's just a speculation, not investing. So how do you know if you have a great franchise? And I've spent a lot of time thinking about this. On this page, you can see the example I use is Disney's Cars franchise, which is one of the top character brands of all time. With dozens of media platforms, take Pixar, for example. Most movies, most theatrical productions don't make companies money. The studio retains about half the box office haul. There are huge marketing budgets. You have to pay the actors and talent involved. So like I said, on its own, you could see here that Cars 1 made $120 million in profits for Disney, but all the other Cars movies have lost Disney money. Yet from the sale of toys and lunchboxes and bed sheets and health and beauty aids and food products and so on, the Cars franchise has made Disney north of $20 billion. So I would suggest, and I think this is important, there's a lot of small kids companies and studios out there, just media companies in general, and they all claim to have great IP. One of the things that I've, realized over the years, people could talk about how great their IP is, but the only evidence that suggests that you're sitting on great IP should be borne out in consumer product sales. And if it's not, you don't have a great franchise. Maybe you're building one, but like I said earlier, that's more akin to speculation. So back to WildBrain, at the center of all of this is the Peanuts Snoopy franchise and their new Apple TV partnership. And it's actually crazy how much content has been created in this new partnership just over the last 2.5 years. In addition to licensing the entire back catalog, WildBrain has created tons of new content for Apple TV+. They've created 2 different TV series, Snoopy in Space and The Snoopy Show. Both have been hits on Apple TV. Each series has already aired 2 seasons. WildBrain has also created multiple holiday specials for Apple TV to complement the Peanuts holiday classics. New specials include Earth Day Special, It's the Small Things Charlie Brown, Mother's Day Special, To Mom and Dad with Love, New Year's Eve Special for Auld Lang Syne, and Back to School Special, Lucy's School. WildBrain has also produced 2 documentaries for Apple TV, Peanuts in Space and Charles Schultz Tribute, Who Are You, Charlie Brown? If anybody is that interested in digging deep enough and understanding why I think Apple is turning this into one of the top character brands in the world, if you were to watch one piece of content, I'd recommend going on your iPhone on Apple TV and just watching Who Are You, Charlie Brown? It's the Charles Schultz biography, and it's phenomenal. And I think you'd walk away saying this is going to be big. And just as evidence what Apple TV has done with this brand, prior to the Apple TV deal, Peanuts was the 7th largest character brand globally by consumer products retail sales, doing $1.7 billion per year. In just 2 years, Peanuts is now a $2.4 billion brand at retail. And I think that puts it at number 5, which is pretty incredible if you think about it. This has become a very valuable franchise for Apple TV+, and when the license expires, I'd be shocked if Apple let Peanuts go elsewhere, and my guess is that they buy the entire company. So really quick, the other properties that they've activated, like I said, all of them have demonstrated consumer product success in the past, and they believe it will again. Like I said earlier, I would note that they are only signing deals that are generating profits on the content production side, and in most cases receiving large one-time lump sums by also licensing the large back catalogs, but consumer products provides the massive upside here. So a quick list of properties that they've reactivated thus far with partners. You have new Yo Gabba Gabba content with Apple TV, which was signed last year and rolls out in 2023. Yo Gabba Gabba has a popular musical franchise behind sold-out live tours in 60 cities. You have new Strawberry Shortcake content on various AVOD and streaming platforms and new specials rolling out on Netflix next year. Strawberry Shortcake was doing $1 billion per year in consumer product sales at its old peak in the late 90s. $1 billion per year is a huge brand. Caillou, new Caillou specials are rolling out on Peacock next year. Caillou is a top 1% channel on YouTube and has sold 15 million books worldwide. A new Sonic the Hedgehog TV series, Sonic Prime, is rolling out on Netflix this winter. Sonic has $6 billion in lifetime franchise revenue to date, and the brand has never been as popular as it is right now with the latest live action movies. WildBrain is an equal partner in all the consumer products tied to Sonic Prime. And then a new Teletubbies TV series is rolling out on Netflix this November. Teletubbies, formerly like Strawberry Shortcake, did $1 billion in annual retail sales at its peak in the 2000s. On Eric Ellenbogen's first call as CEO in mid-2019, in discussing the amazing opportunity at WildBrain, he highlighted that Teletubbies had done less than $1 million in consumer product sales in the prior year. If the company can capture even a fraction of historical CP success with any of these brands, they'll blow by 2023 and, more importantly, 2024 guidance. I believe they will. There are also multiple other brands that will be turned on in the coming months and years. So back to consumer products. I think this is a crazy page, and this is from their investor day in January of last year. But they put this here as an illustration of the contribution of $1 billion brand at retail. And if you look on the left here, and this is for an owned brand, they own 100% of Strawberry Shortcake. They own 100% of Teletubbies, which were both billion-dollar brands at once. So assuming $1 billion brand wholesale, that translates into, retail gross sales, that translates into roughly 500 million wholesale gross sales if you assume a 50% retail gross sale. And then assuming a 10% royalty, that gets you to a $50 million royalty. And after SG&A, you're looking at 45 million incremental EBITDA. So I'm not suggesting that Strawberry Shortcake and Teletubbies and Caillou and Yo Gabba Gabba and Inspector Gadget and In the Night Garden and Chip and Potato and just all these brands with great histories of consumer product success that have been, kind of at a stalemate for a couple of years. I'm not suggesting that they get back to where they were, but collectively you're talking about brands that have histories of consumer product success that probably combined, you're looking at $4 billion per year. So even if you were to capture half of that, you're looking at an incremental $100 million EBITDA to their base 125 million 2024 guidance, which would put this company at 225 EBITDA. And obviously that's all upside, but you could see how this is a consumer products juggernaut. So, finally, how I think about valuation. The company has guided midline 125 million for fiscal 2024, which suggests 20% annual growth from here. They've been very deliberate to mention that this guidance is entirely based on already contracted deals where they have high visibility, and that switching on more IP, activating partner IP, and consumer product success represents upside to that base 125 million number. I think they blow past this number and come closer to 150 or 200 million EBITDA if you consider that multiple new projects have been announced since giving those original projections, and it includes no consumer products upside. Just as comps, and I understand the environment's different today than it was a couple of years ago, but Hasbro bought E1, which was the owner of Peppa Pig and PJ Masks, and really they bought those two brands and shut down everything else. Amazon bought MGM Studios, which had a library, but most known for a few brands like James Bond and the Pink Panther. And then private equity bought CoComelon. All three of those deals were were acquired for roughly between 30 to 35 times EBITDA. Assuming the base 125 million fiscal 2024 EBITDA number, WildBrain is a double at a 10 times multiple. It's more than a triple at a 15x multiple, and it goes up 5x, assuming a 20 times multiple, which is a lot lower than other transactions in the space. I think 2024 EBITDA is a lot higher than guidance, and I think it's possible that the multiple paid for this asset is closer in line to comps. So, you know, I mean, it sounds crazy, but, you know, my base case, you know, in WildBrain is that you double your money, and that's if everything goes wrong. And I think it's more likely that this is a 5 to 10 bagger from here. And what's amazing is the turnaround is well underway. They've already announced all these deals. Eric Ellenbogen's been at the helm for 3 years. He just signed on for another 3 years, which would suggest that, you know, he's going to be here to see it through. And, you know, I think this is a very viable company as a standalone, but I'd be surprised if it wasn't bought by one of the bigger streaming services in the next 2 to 3 years. So anyways, I appreciate the time. I think this is a great opportunity. You could find my email address on our website, oldwestim.com. And as Ian will agree, and as all the other great presenters today will agree, you know, one of the things that we do as money managers is just sit around and talk about our ideas all day. So if anybody has any questions, I would love to collaborate. So thank you, Ian. Thank you for everybody for tuning in, and I appreciate this opportunity.
Thanks, Joe. Yeah, if anybody's had any questions for Joe, feel free to email him. You can, I think he gave you his email address. Feel free to reach out to him directly. Thanks, Joe, for participating. We're gonna cut things off now. We have about 50 minutes until our afternoon session starts. So I know I got to shut down and eat something. So I hope everybody enjoyed the morning session, and we'll see you back in about 50 minutes. Thanks.
Thank you.